Etsuani, Uganda, Zimbábue, Seychelles, Moçambique, Zâmbia, Malawi, Costa do Marfim, Quênia, República Democrática do Congo, Lesoto e Angola. Este seminário contou com a participação de 52 delegados internacionais e 30 nacionais, dos quais toda a supervisão de seguros, toda a direção de supervisão, num ambiente marcado pela cooperação, pela troca de experiência e pelo reforço das capacidades técnicas e institucionais de todos os reguladores da África Subsaariana aqui presentes. Durante este período foram debatidos temas centrais para o presente e o futuro da supervisão e regulação dos seguros a nível da África Subsaariana, incluindo inclusão financeira, supervisão baseada no risco, regulação e supervisão inteligente, conduta de mercado, função atuarial, riscos climáticos, normas internacionais de reporte financeiro, solvência, harmonização da legislação e capacitação institucional técnica. Para o nosso mercado, parece coincidência que todos os temas aqui debatidos são os temas que estão na agenda do Plano Estratégico da ARCEG 25-29, que não é coincidência, porque são os temas que o mercado africano também se debate. Sem prejuízo, estamos abertos ao mundo, repito, problemas africanos mais facilmente serão resolvidos com soluções africanas, porque os nossos irmãos vivem exatamente aquilo que nós vivemos. E então é muito mais fácil copiarmos aqui numa realidade igual à nossa. Copiamos, reproduzirmos, debatermos, nos incentivarmos e nos apoiarmos, pois o futuro do setor segurador da África Subsaariana depende da nossa capacidade, enquanto continente, de trabalharmos em unidade. E as reflexões destes dias demonstraram o nosso compromisso coletivo com o desenvolvimento dos mercados de seguros a nível da África, mercados estes que queremos mais robustos, mais sustentáveis e alinhados com os desafios e oportunidades da nossa realidade. A troca de experiência e as lições partilhadas, o espírito de cooperação que aqui se viveu, são um sinal claro de que a África Subsaariana está alinhada no propósito de evoluir e consolidar sistemas de supervisão fortes, transparentes e preparados para o futuro. Hoje e amanhã abrimos este fórum ao mercado, os operadores, e a sua contribuição para o desenvolvimento econômico, bem como os caminhos para alargar o acesso ao seguro e reforçar a proteção da população. Os temas debatidos serão agora revisitados com o mercado, porque acreditamos que a construção de um setor sólido depende de um alinhamento entre quem regula e quem opera, o que reforça mais uma vez a importância da articulação entre supervisores e operadores para que o setor possa então evoluir de forma equilibrada, segura e alinhada com as melhores práticas internacionais. Estamos certos de que a vossa participação ativa é fundamental para o aprofundamento do diálogo e para a construção conjunta de soluções sustentáveis, eficazes e ajustadas ao nosso continente. Minhas senhoras e meus senhores, este é um momento de escuta, de convergência, de afirmação do nosso compromisso coletivo com o setor segurador mais robusto, mais transparente, mais inclusivo e mais preparado para os desafios do mercado. Para proceder à abertura oficial desta conferência, hoje, no feriado, e denotando mais uma vez o apoio institucional e governamental que temos recebido a nível do Executivo. Temos a honra de contar com a presença de Sua Excelência, o Secretário de Estado para as Finanças e o Tesouro, Dr. Otoniel Lobo dos Santos. Dr. Otoniel Lobo dos Santos tem um desempenho e um papel central na definição e execução das políticas públicas que promovem estabilidade macroeconômica, modernização do setor financeiro e fortalecimento institucional do nosso país. A sua liderança tem sido um pilar para a confiança e para a transformação do ambiente regulatório em Angola. Portanto, é com grande consideração e estima, é com grande expectativa que o convidamos a dirigir-se a esta Assembleia e a proferir o discurso de abertura oficial da Conferência Iais África Subsaariana. Com os senhores, Sua Excelência, Dr. Otoniel Lobo dos Santos.
Good morning, ladies and gentlemen. I came prepared to make my speech in English, but as I am among the supervisors and regulators, we will have to follow some rules. So one of the rules that was made was that we should speak Portuguese. So I will do my speech in Portuguese, if you allow me, because I have to follow the rules. So, with that said, I will say, Excelências, Senhores, membros do Conselho de Administração da ARSEG, Excelentíssimos Senhores representantes da Associação Internacional dos Supervisores de Seguros, distintos delegados, convidados e parceiros internacionais, minhas senhoras e meus senhores, muito bom dia. Good morning. É com grande honra que damos boas-vindas a este seminário regional da Associação Internacional dos Supervisores de Seguros e a IES, aqui em Luanda. A escolha de Angola como anfitriã não é um acaso, é um reflexo de um país que decidiu colocar o seguro no centro da sua estratégia de estabilidade macroeconômica, proteção social e desenvolvimento sustentável. A presença de todos nos traduz o reconhecimento do esforço reformista de Angola e do papel crescente da ARSEG no ecossistema africano e internacional de supervisão de seguros. Celebramos este ano os 50 anos de independência. É um marco que nos convida à reflexão sobre o caminho trilhado na construção de um Estado moderno e com instituições econômicas cada vez mais robustas. O setor segurador é parte integrante desta evolução, enquanto instrumento de mitigação de riscos, de promoção de inclusão e de estímulo ao investimento. Com reformas legislativas, políticas públicas assertivas e ação regulatória consistente, temos vindo a consolidar um mercado mais transparente, competitivo e centrado no cidadão. A ARSEG tem desempenhado um papel decisivo nesta transformação, promovendo uma supervisão técnica, independente e alinhada com os princípios da IAIAS. Desde a sua adesão, em 2020, o setor registrou um crescimento notável. Os prémios duplicaram entre 2020 e 2024, passando de 223,8 mil milhões de kwanzas para 473,7 mil milhões de kwanzas. Ainda assim, a taxa de penetração permanece em 0,6% do PIB, o nosso produto interno bruto, sinal claro do potencial a explorar. O ramo vida embora ainda minoritário, cresce de forma promissora, enquanto o pagamento de indemnizações aumentou 74%, reforçando a confiança no setor. Este progresso assenta num novo quadro legal, a Lei nº 18/22, que introduz uma supervisão baseada no risco, reforçou os requisitos prudenciais, valorizou a mediação profissional e criou espaço para a inovação digital. Angola dispõe hoje de um sistema jurídico regulatório mais robusto, credível e preparado para os desafios emergentes. Distintos delegados, convidados e parceiros internacionais, minhas senhoras e meus senhores, importa agora olhar para o futuro. O Executivo, por via do Ministério das Finanças, assume compromissos concretos. Aumentar a taxa de penetração de seguro para 3% do PIB até 2029, expandir o seguro agrícola, microseguro e o seguro para métricos, sobretudo em zonas rurais. Implementar de forma eficaz a Estratégia Nacional de Inclusão Financeira, fomentar um ecossistema regulado de inovação digital no setor. Estes objetivos serão acompanhados de metas claras e mecanismos de monitorização que assegurem coerência entre ambição e ação. Os temas selecionados para este seminário não podiam ser mais oportunos. Vivemos tempos de mudanças aceleradas e riscos sistémicos crescentes. Permitam-me destacar 6 eixos estratégicos. A implementação do regime de solvência baseado em riscos, a adoção das IFRS 17 para maior transparência e comparabilidade, o reforço da conduta de mercado e de proteção do consumidor, a expansão do microseguro como instrumento de inclusão, a resposta aos riscos cibernéticos num contexto de crescente digitalização e, finalmente, os seguros paramétricos como resposta às alterações climáticas e aos eventos extremos. Estes desafios exigem uma ação coordenada, partilha de boas práticas e reforço da capacidade regionais. Angola está pronta a contribuir para este esforço coletivo. Excelentíssimos representantes da IAIS, distintos delegados, em nome do Governo de Angola, agradeço pela vossa presença, pela parceria com a ARCEG e pelo contributo de cada um para o sucesso deste encontro. Que este seminário seja um espaço de cooperação, compromisso e fortalecimento institucional, que fortaleça a confiança entre os supervisores, promova soluções adotadas à realidade africana e valorize a regulação como um verdadeiro bem público. Desejo-vos uma estadia memorável em Luanda, cidade que vos acolhe com hospitalidade e calor humano, e uma semana de trabalho profícua, marcada por trocas construtivas, alianças estratégicas e avanços tangíveis. Declaro oficialmente aberto o Seminário Regional da Associação Internacional de Supervisores de Seguros. Bem-haja, estamos juntos, que Deus continue a abençoar a nossa pátria. Muito obrigado.
Thank you, Mr. Antonio. Following the keynote, we now take a regional lens, looking at Africa's insurance landscape as a whole.
So that's why it's my pleasure to welcome Mr. Takalani Sivakavaka, partner at Deloitte South Africa and the members of the Actuary Society in South Africa, who will provide a broad overview of industry development across the continent. Please, a round of applause.
Good morning, everyone. I'll be speaking in English. Unfortunately, I can't speak Portuguese. I only speak English and my native language. My name is Takalani Skabakaba. I'm an actuary, a partner at Deloitte, South Africa. It's really an honor to be speaking in front of you and to engage with you. I'm looking forward to having fruitful discussions with you. Maybe just to introduce myself, as I said, I'm an actuary. I'm a statutory actuary for a number of companies in our beautiful continent. I often find myself everywhere in the continent. I do business across a number of companies. I go to Lesotho, Eswatini, my home country, South Africa, Zimbabwe, Malawi, Ghana, Kenya, Nigeria. I often travel providing actuarial support, speaking at various insurance and actuarial conferences. I often write a number of articles, mainly on the actuarial landscape, talking to what's happening in our markets. I'm a life actuary, but I also do short-term insurance and medical scheme consulting. I have touched a number of countries, and today, really the ask for me was to come and speak to you in terms of what we call Deloitte Insurance Outlook. As Deloitte, we produce a publication each and every year that looks at what's happening in the insurance market in the continent. It covers a number of pieces, number of areas, and I will summarize it for you, but if you want to read, I have included a link in my presentation where you can go and read it. We are about to produce the next version, which will be produced around June. So I'll encourage you to go and look and have a read, and we can have a discussion. Yeah, thank you. As I said, in terms of the agenda, I'm going to speak to you about the Africa Insurance Outlook. The Africa Insurance Outlook is a publication that Deloitte produced that talks about the developments in the insurance market. In that Insurance Outlook, I have written an article or a paper that talks about the future of insurance. A lot of people believe that the future of insurance is still African. I still believe it's still African. You look at a number of areas: GDP, insurance penetration ratio, population, technology, the roles that us as regulators we can play to make sure that the future of insurance is still African. Just to summarize the Deloitte Africa Insurance Outlook, it covers a number of topics. There is a topic where we look at results of major insurance companies in South Africa that covers roughly 80% of the market. We look at what's happening in the region, West and East Africa, regulations that are happening. We often speak about risk-based supervision. A number of regulators have announced that they want to adopt RBC. There's an exciting development. The key theme post IFRA 17 or with IFRA 17 implementation was ESG. Everybody has been speaking about ESG. Technology, you can't speak of insurance without speaking about AI, without speaking digital adoption. This is how the insurance outlook look like. This is the page that I took from the insurance outlook. As I said, sorry, this is the page that, this is the contents of insurance outlook. We have an introduction that summarizes what the insurance outlook is talking about. We have results, we have regional insurance view, we have East Africa insurance outlook. We also look at what has been happening in Ghana, regulations. In South Africa, there has been, the regulator was focusing more on liquidity risk, ESG. We still look at what's happening in the industry, and this is one of the papers that I'll be talking to you, digital, in terms of what's happening. In terms of results matter, just to summarize it, we look at 80% of our insurance players in South Africa, what has been happening post-IFRS 17 implementation. What we have seen is that we saw a growth in both non-life and life insurance operations, with non-life operation growing by around 13%. IFRS 17 came in. What we saw, IFRS 17 is a reporting standard. It's not a reserving standard. So we didn't see any changes in terms of capital. In South Africa, with capital, there's a RBC regime, solvency and asset management, that's similar to Solvency II of Europe, that insurers use to measure capital. So the financial reporting is separated from prudential reporting. I will be speaking about that tomorrow in details when I speak in terms of what has been happening in IFRS 17. So that's results matters. In terms of East Africa, we look at what has been happening in the East African market. Insurance penetration remains very low, around 2.25%, slightly higher than what we are seeing here in in Angola at 0.6%, indicating this area of growth. IFRS 17 implementation in Ghana, the regulator there in Ghana played a significant role to make sure that the industry can implement IFRS 17. There was training, there was number of implementation workshop, there was improvement in the regulatory returns. The regulator came in and tried to help with design decisions. IFRS 17 came with a number of design decisions. The industry was not certain in terms of how to implement certain things. The regulator came and assist there. I already spoken about what has been happening in South Africa with liquidity risk. The regulator came and assist in terms of how liquidity can be measured. ESG, and as I indicated, post IFRS 17, a number of insurers, a number of insurance regulators have been focusing on sustainability. How can we sell inclusive and more sustainable insurance? So there's an article in that paper that talks about sustainability. I won't go to this into detail because I'm going to be speaking to that. There is an article that I wrote, is the future of insurance is still African. There was also another article that talks about product rationalization. We have a lot of legacy products, and those legacy products, they are very costly to manage, and maybe rationalizing them, grouping them with other new products, it can reduce cost and bring some sort of efficiency. So there's an article that talks about how can we reduce that, because you still need to manage them, you still need to continue speaking with the policyholder in terms of operations of that product. So, but if you reduce the number of those products, you can bring efficiency in insurance. There's an article that talks about digital, how AI can come in the insurance space. How can we use AI in our operations, in our underwriting, in our sales, in all the areas where we can use technology to gain value. The article that I wrote that I really wanted to speak to you is is the future of insurance still African? My answer for this one is yes. When you talk about our beautiful continent, Africa, in terms of insurance, there's a lot of things that people talk that makes Africa very attractive. You talk about a GDP growth rate. It is usually higher than most advanced countries or most advanced economies. You look at our population growth. We have a growing and useful population. It provides attraction. Insurance penetration. The minister spoke about the insurance penetration of 0.6% here in Angola. It's really makes Angola very attractive. It means there's room for growth. Insurance, the regulatory landscape. We are, as Africa, we are implementing standards that are global. IFRA 17 is not an African standard. It's a global standard that we are also implementing in Africa. We're also implementing it at the same time. We implemented it at the same time when the rest of the world is implementing. There are other countries that chose not to implement, but Africa implemented it. You as the regulators have been speaking about risk-based supervision. Risk-based supervision is not an Africa-wide phenomenon. It's a global phenomenon. And if you look here in our African continent, South Africa, Zimbabwe, Kenya, Zambia, and Morocco have implemented some form of risk-based supervision. And they, as you, as the regulators, there's an opportunity for you to implement. But then again, we are a continent with challenges. The GDP growth rate, the GDP hasn't been growing as at a rate that we thought it would post-COVID. Debt crisis. We are a continent that likes to borrow a lot, and sometimes we see struggles. You have seen what has been happening in, for example, in Ghana with domestic debt exchange. Interest rates have been rising, and also if interest rates are rising, the cost of debt, our GDP, we spend a lot of money repaying debts. Inflation, we have some of the worst inflation. I see the commissioner of Zim is in front of me. In Zimbabwe, there's inflationary pressures in Malawi, in Nigeria, energy availability. In South Africa, where I come from, we have a term called load shedding. So we have we're struggling with energy. In Zambia, when you go, there's challenges with energy. In terms of my article looks at the attractiveness of Africa in terms of a number of things. The first one is the GDP growth rate. The real GDP growth rate in sub-Saharan Africa continues to experience lower GDP growth rate than East Asia, mainly driven by China and Bangladesh. But the Africa real GDP growth rate, we have faced a number of challenges, including specific national challenges. If I look at Kenya, the GDP growth rate increased by 5% in 2023 from 5% in 2023 to 5.2% in 2024. The economy in Kenya is usually dependent on agriculture, and if there's drought, that can easily impact it. If I look at South Africa, the economy is forecasted to grow by less than 1% or around 1 to 1.5%. And the challenges in South Africa really is power cuts, rising inflation. Nowadays, we also have the US bringing a lot of tariffs to our markets. So we find a lot of challenges. Nigeria, Nigeria is largely dependent on the oil, similar to our economy here in Angola. And during COVID-19 pandemic, we saw a slowdown in the Nigerian economy because of lower demand of oil. We have seen those who work in the Nigerian market. We have seen the naira depreciated. There is two markets. There's an outside market and a formal market for Naira Stock Exchange in Nigeria. However, despite these challenges, our growth rate is still better than Europe and some parts of Asia, providing an opportunities for those who want to come and invest in our country to come in and tap in. So there's a market for growth. And again, looking at insurance penetration ratio, if you look at this graph, you can see South Africa is 11.54% and is at the top end. But if you look further down, we have Nigeria. Nigeria is one of the biggest economies in our country, in our continent. The population in Nigeria is very big, but you look at the numbers, the insurance penetration ratio is around 0.4%, Angola 0.6%, Zimbabwe 1.23%, Zambia 1.32%, Eswatini 2.23%, Kenya 2.25%, Tunisia 2.28%, Botswana 2.46%, Morocco 4.1%, Mauritius 4.97%, and you look at the global average of around 6.8%. It shows that the African market is untapped. There's a lot of work that we as regulators, we as insurance practitioners can do. So if you just remove South Africa, overall the insurance penetration in Africa is between 1 and 2%, which indicates that insurance penetration is very low. A lot of innovative insurtechs have been looking at this, and they're trying to tap into this market. I have listed a number of insurtechs that have been trying to tap into this gap. There's insurance in Kenya, AP Insurance. They've been trying to use digital platform to sell health insurance, to try to increase this insurance penetration. Turaco as well, an insurtech in Kenya that operates in Uganda and Nigeria, has been trying to provide tailor-made health insurance cover to low-income individuals and families. Pula, again, an insurtech in Kenya, has been playing in the agricultural space to try to tap into this uncovered insurance market. Another nice thing to look when you look at Africa, you look at our population. It's very large and it's growing. You can actually see from 1990 we had roughly below around maybe 0.6 billion people. Now we projected to be around 2.5 billion. We are just below 1.6 billion, but we are projected to be above 2.5 billion by 2050. And you can see this growing population, it provides a market for us to sell insurance. The population, 70% of the population is below the age of 30. It means our population is useful. And for you to tap into this useful population, you need to change in terms of how you sell your insurance products. The useful population, they tend to be digital. They tend to be digital savvy. They tend to have access to cell phones. So we have seen innovative insurance companies that are using cell phone technology to sell to this useful population. I have Bima there in Kenya and Ghana, Pineapple in South Africa. They are selling insurance using cell phone. I've seen companies partnering with cell phone providers, network providers, MTN, with Ayo and Sanlam, trying to sell insurance using digital platforms. And this is really helping to reduce that low insurance penetration problem. We have also seen that traditional insurance companies, for example, Sanlam and Old Mutual in South Africa, they come into play. They are also using digital platforms to sell insurance to this useful and young population. In terms of regulators, we have also seen regulators coming to play. As I said, regulators in Africa, they are implementing standards that are not African standards, that are global standards. IFRS 17 has been implemented in Africa. Risk-based capital regime have been are being implemented in South Africa. The regulators are playing their part. If I look at some of what has been happening in regulators in South Africa, the Insurance Act introduced a new licensing requirement for microinsurance, so that they can sell innovative insurance products to low-income providers. In South Africa, we have seen the growth of self-captive insurance, where non-traditional insurance players are coming. They can get access to an insurance license from an insurance provider, and then they sell insurance. We have seen shops, retailers selling insurance, and they trying to bridge that low penetration ratio. In terms of, in my conclusion, there is immense opportunities for insurance players in Africa. We have seen a number of insurtechs and startup companies coming in and selling insurance to policyholders who were previously untapped. We have seen EU regulators coming into play to try to open the market for innovative players, to bring regulations that are in line with global standards. We have seen players without insurance licenses coming in to come and sell insurance, partnering with insurance company to sell insurance products. So is the future still African? In my view, yes, the future is still African. There's a lot of opportunities in our African market for us to grow and sell insurance, and for us to increase that insurance penetration ratio. As I said, this presentation is based on the article that I wrote on the insurance outlook, Deloitte Insurance Outlook. There's a link that I provided at the beginning of my presentation that if you want to, you can go and read more. We in the process of launching the next version of Insurance Outlook. I encourage you to go and read. I also have written an article that I'll be talking to you about tomorrow that talks about, can you really use IFRS 17 balance sheet for regulatory reporting? I basically feel that's, given that you are the regulators, that will be the article that talks to you more, and that that would be closer to your heart. But this is what I had to share with you today, and I'll take this opportunity for questions. Thank you.
Has anyone got any question? Yeah, we have back there.
Oh, thank you, Takalani, for the insightful presentation. So with regard to IFRS 17, you said it's a financial reporting standard that is separate from capital. I think you will have to explain that, because in my understanding, those different measurement models separation of insurance and investment component, I think we have seen the impact that they have on the capital. So please explain what you meant that it's a financial reporting standard that is separate from capital.
Thank you, Speaker. I couldn't see where you are speaking from. I was trying to look.
I'm Leboha Mulezane from the Central Bank of Lesotho.
Thank you. Thank you very much for that question. Yeah, as I said, tomorrow I'll be speaking more on comparing the IFRS 17 balance sheet and the solvency balance sheet. And really, the two are different. IFRS 17 is a reporting standard. It looks at performance of insurance contracts and produce financials, and those financials are there really for the investors, for the shareholders to really check the performance of the insurance company, how is it performing. And if you look at your role as regulators, regulators are there to maintain stability. They are there to protect the interest of the man on the street. You are there to make sure that insurance company is solvent, and insurance companies are solvent, and they continue to remain solvent in the future. So the objectives of IFRS 17 and objectives of regulatory reporting are not the same. So there are elements of IFRS 17 balance sheets that are not that are not aligned with the objectives of IFRS 17. So what we have seen is that in certain markets, such as Europe, there's a regulatory reporting standard, such as Solvency II, and there is also an IFRS 17 or IFRS reporting standard, such as IFRS 17. Because of those differences, tomorrow I will delve into details in terms of why we believe IFRS 17 is not suitable for regulatory reporting. I'm not sure if that answers your question.
Just a quick note, before you make a question, please introduce yourself.
Okay, this is just a follow-up. I think what I'm trying to determine is, are you saying that the measurement of insurance contracts in IFRS 17 won't affect the regulatory capital? I think that is what I wanted to know.
Yes, so it really depends on the country that you operate. So I'll look at different countries. If I look at South Africa, in South Africa there is SAM, Solvency and Asset Management, which is a regulatory reporting standard, which was based on Solvency II. Then there is IFRS 17. So there is two different reporting standard or reporting bases. So IFRS 17 won't impact SAM. Then if I look at ZIM, in Zimbabwe there's what we call a ZICAP framework, which is different from IFRS 17 reporting. If I look at Zambia, for example, I saw Dr. Mashishi is here. In Zambia, they are in the process of aligning regulatory returns, given that we have IFRS 17. Previously, under IFRS 4, there was no distinction between IFRS reporting and regulatory reporting. In Lesotho, for example, the capital requirement in Lesotho, they are based on some factors of liabilities and factors of assets. So they still link to IFRS reporting, IFRS 17 reporting. But in many countries, we are seeing that because of challenges that IFRS 17 is bringing, for regulatory reporting, people are moving away from IFRS reporting. If you look at Kenya, for example, Kenya, there's still a link between IFRS reporting and regulatory reporting. The capital requirements in Kenya, they are based on three things. I think it's 400 million shillings or 5% of best estimate liabilities. And those 5% of IFRS 17 liabilities and also the RBC requirement. So that 5% of IFRS 17 liability, if it's the biting measure, then they say link IFRS 17. But tomorrow I will be discussing with you and showing you why maybe IFRS, linking to IFRS 17 reporting, it might not be the correct way to do things, because there are elements of IFRS 17 reporting that don't align with regulatory requirements.
Any other question, please? Before making question, we can only ask you to introduce yourself, please.
Good morning, everyone. My name is Denda Musolo. I'm from Zambia, PIA. I was looking at the penetration ratios, in particular South Africa. What really makes it stand out to be 11%? Is it any specific book of business, or maybe it's a macros? Thank you.
Yeah, thank you. Yeah, as I'm a South African myself, so I also speak based on what I've seen on the ground. But we also have regulators from South Africa here that can also speak to that question. But if you look at the insurance market in South Africa, is very developed. The regulations they align with what has been happening in the more developed countries in Europe. I spoke about the risk-based regime in South Africa. We have solvency and asset management that is very similar to Europe. The protection of customers regulations, the TCF, again, very similar to Europe. We usually implement just after Europe has implemented. And there's a lot of trust because of regulations. South Africa also has its unique problems, and with unique problems, people tend to seek insurance. South Africa has the crime rates. If you buy assets, you need to sort of insure them because of those problems. The financial service market in South Africa is really developed. The banking sector is very developed. When people take loans, they need insurance cover. The federal market, the federal culture in South Africa is very big. It's a growing market. So all those contribute to that high insurance penetration. And again, even in South Africa, even though it looks like 11.54 is very high, we still have a lot of untapped customers that insurance companies are trying to go and sell insurance to. That's why I spoke about the introduction of the micro insurance bill, ensuring that the low income people are also covered by this insurance. So that's, in my view, is what contributed to the 11.54% insurance penetration in South Africa. If I look at Nigeria, I think in Nigeria there are challenges. The regulator NICOM has a number of compulsory or mandatory insurance cover, but the market hasn't been taking. There are a lot of cars in Nigeria. The cars in Nigeria are supposed to be insured, but not all of them are insured. So there's a role for the regulators to enforce those mandatory insurance covers, and that can help drive insurance penetration. The population in Nigeria is very high. very useful. So innovative insurance players can come and drive insurance penetration. There's been a number of developments in Nigeria. The insurance sector bill that NICOM is planning to introduce around December last year is trying to address this problem of low insurance penetration. But the real challenge is really enforcement. You can have a nice bill, you can have a nice act, but where for you as insurance regulators, you need to be able to enforce that bill, and also maybe hold those who are supposed to enforce it accountable.
Enda da Silva, Angolan Actuarial Society. Thank you, Takalani, for your presentation. My question is very similar to the last one. When you say that the future of insurance is still Africa, in which line of business do you think we have more potential to grow? Properties, medical, or life, for example? Thank you.
Yeah, thank you very much. I think that's a great question. And looking at these statistics that we have in front of us, it really says all lines of business. There's significant growth in all lines of business. If you just walk out and ask how many people have any type of insurance on the street, very few people have insurance. And the stats basically says all lines of insurance. In South Africa, on health insurance, the medical schemes covers around 17% of the population, and the government is trying to address that by introducing national health insurance. And it basically says that there's a lot of untapped market, and the statistics are the same across. We can bring as much countries as we can include here, but you have the same challenges. So all lines of business.
Any other questions?
Yeah. If there are no questions, I'll be around today and tomorrow, and really keen to network with you, really keen to talk to you about what's happening in our beautiful country. And as I said, it's really an honor for me to come here and speak with you, speak about insurance. It's not very often that you speak to honorable members such as the ministers and regulators. So I'm really honored to come here and share my contribution to growing our insurance market. There's a lot of work to be done, but I believe we can do it. Thank you.
Thank you, Takalani. Now it's time for a break, and we invite you to enjoy a cup of coffee. And before that, I would kindly ask the Secretary of the State, Mr. Antonio. I have to invite you to the stage, and the Board of ARSEG and the Insurance Commissioner to take a group photo, please.
Yeah. Just 3 minutes. Please, you're welcome. You're welcome.
There's so many photos to take, so we ask you to go to outside in our backdrop to take another photo, please. Commissioners, the board of RSEG, and the Secretary of the State.
Okay, we'll be back here at 11 with more insight into emerging risk and the role of the insurers in African economic sustainability. Thank you very much, and go to our first coffee break of the day. Yvonne Palm, Director of Compliance at the Africa Hair and co-founder at the Africa Actuarial Development Academy. Please, a round of applause.
She will take us through key emerging risks in the region and how supervisory frameworks can evolve to respond effectively.
Morning, everybody. Or bom dia. I hope I've said that right. I also do not speak Portuguese, so apologies. I will be speaking in French. But yes, I'm Yvonne Palm. I'm based out of Lagos, so some of my examples might include some references to power. You know, when Takalani was speaking earlier, he was like, oh yes, in South Africa, we struggle with power. I was like, You know, in Nigeria, sometimes we're on generators for 24 hours. So anyway, so I'll be taking you through emerging risks in the sub-Saharan African insurance sector. Let's see. Okay, so there's some goals that I have with this presentation. So first of all, understand some emerging risk trends, and I will be focusing on the risks. Just remember that with risk, there is opportunity as well. So I'm not just the angel of death and gloom, you know, trying to scare you, but there are opportunities aligned with some of these risks as well. So I also would like to visualize some risk interactions with you and then also focus on some resilience strategies. So bear in mind that these are just some of the risks that are applicable. I did base some of my presentation on this Iais Global Insurance Market Report, which you can reference for some more information. But I have added some of my own thoughts to this as well. So just keep that in mind. And then also, I just want to make sure that you understand that these are my views, not the views of the IAIS or the views of my employer. So the first risk I just wanted to touch on is in terms of global economic and geopolitical pressures. So right now, you know, you wake up, you listen to the news every day, there's something new, right? Something new, particularly coming from the US. But the world seems like it's at tenterhooks. And there are various things happening that do impact the insurance sector. We are in financial services, it does impact insurance sector. So people are talking about possible economic recession. We'll wait to see what happens there. There's rising inflation globally. You know, within Africa, we're used to inflation, right? We're used to double-digit inflation. In fact, some insurance products even account for that. But when inflation's happening abroad, it can exacerbate that issue, and then also inflation in general. Okay, I always have this problem. I'll try again. I speak really fast. So I'm gonna try and slow down. So inflation in general does impact insurance products. I'm sure you are familiar with this. The next item is supply chain disruptions. So, you know, I think for insurance in general, again, this is something that impacts us directly. We do insure these supply chains, and since COVID happened, we've experienced a lot of this, right? So when COVID happened, it revealed the cracks in a lot of these supply chains globally. So we found that a lot of issues that happen in one place in the world can impact other places. And I'll touch on this a bit more. Macroeconomic management, that varies by country, obviously. So fiscal and monetary policies being implemented in different countries can impact your insurance products. That varies. I'm not going to touch into that in lots of detail, but just, you know, as in the country that you're operating in, whatever's happening in the macroeconomic environment can impact your insurance products. So just make sure that you are you're paying attention to all of this. And then, of course, global sovereign debt crisis. Again, this has to do a lot with, this can impact what's happening in countries, right? So if a country owes it owes a lot of people, right? The debtors will tell you what to do with your money. They'll tell you where to put it, and that can impact what's going on in the country. And I also find it very interesting what's happening right now with the US and China and their tariff war, when the US owes China a lot of money as well. So I'm actually going to talk about that next. I hope I'm managing for the interpreters. Okay, so global events. This says, will they impact Africa? The answer is yes, they do. So the question is, how will they impact Africa? Like I think I mentioned before, that global supply chains, everything is connected, right? So gone are the days when you'll sit here and then just say, oh, something's happening, over there in another country. It's not going to impact us. I'm going to go through 2 examples of this. And this is the first one. So US-China trade war happening between these 2 mega economies in the world. We're sitting and just watching and wondering what's going to happen. So I'll go through positives and negatives, right? So let's start with the negative aspect of how this might impact African countries. So China is on its own scramble for Africa currently, right? It's been silently going around Africa, building lots of infrastructure. That's how it's doing it, through the Belt and Road Initiative. So if you're not familiar with it, I do encourage you to read up on the Belt and Road Initiative. But China is going through lots of countries in Africa, building infrastructure. So it's built more than 1,000 bridges in Africa. It's built about 100 ports in Africa. And just remember that about 30% of African countries are landlocked. There are about 54-ish African countries. So that's about 3 ports per eligible country, right? So China's going through building significant amounts of infrastructure all over Africa. And a lot of this, it's funding, right? A lot of this is funding. Lots of risks associated with that, but a lot of this, China's funding. So what happens if this US-China tariff war escalates to such a degree that China decides it needs to focus on its own economy and withdraws from all of those projects, right? The money just dries up, gone. So all these projects are going to be left there empty. So I was in Cape Verde a few weeks ago, and there was this project, like a massive hotel. It was on the peninsula. It had access to this pier that they were building. It was beautiful, huge hotel, towering all the rest that are there. And it was being built by the Chinese. And what's happened is that project just stopped. And we were asking the locals, so what's happened? Do you know what happened here? They were like, no, the Chinese were here, and then they were here one day, and they were gone the next. So this building that's almost completed is sitting there empty. There's a massive crane standing next to it that blows in the wind, right? So me with my actuarial hat on, I was looking at it thinking, oh my gosh, if that crane falls, it's going to hit so many things. Emergency nightmare, right? So imagine that situation where all these pieces of infrastructure around Africa suddenly have that same thing happen to it because China decided it's withdrawing, right? So that could be a significant risk to African countries, and definitely something that people should be monitoring. So let's look on the positive side, right? So if the US-China tariffs again escalate, it could be an opportunity for Africa, right? Because US in particular will be looking for other trade partners. They'll be looking for other places to establish manufacturing plants, right? So Africa has the resources. This is one of the reasons why China is busy scrambling by itself, right, for the resources. Africa also has the low-cost labor, right? So it would really be the countries that have the right infrastructure, and it's, I guess, a two-sided coin because China is helping build a lot of infrastructure. but it's the countries that have the infrastructure that will be able to capitalize on this, right? So, you know, nobody's going to come and build a factory somewhere where they're going to have to run generations to establish their factory. So there are positive sides of this. So infrastructure will be key. And just to also emphasize this point, right? So don't underestimate global connectivity. So if you think back to 2022, when the Russia-Ukraine conflict started, we were all sitting down again, watching TV, going, oh, conflict, okay, it looks like something's happening, but we're also like, oh my gosh, how can this happen in this day and age? But we're looking going, wow, okay, but it's over there. Not gonna hurt us so much. But guess what happened? Egypt, who has had a very stable economy, stable currency, the graph that you're seeing there is a graph showing the US dollar against the Egyptian pound over the last 20 or so years. So stable, yes, in 2017 they had to do an economic reform and they devalued their currency. But you can see they started having it under control, currency was appreciating. Then where that arrow is when the Russia-Ukraine conflict started. And within a month, less than a month, Egypt had to devalue its currency by about 15%. And it was all because of wheat. So it turned out that Egypt had 80% of its wheat coming from these two countries. And Egyptians love their bread. In fact, if you speak to them, you'll find out that like even the 2011 Arab Spring, some of it was driven by the fact that bread was so expensive. So Egyptians love their bread. So the government had to scurry to try and essentially correct things because of this wheat shortage, wheat crisis, prices of wheat. And look at what's happened to the currency now. It's gone from sub 20 into the mid 50s. So don't underestimate what's happening elsewhere and how that might be able to impact what you're doing right now. Closer to home, there's the new airport in Angola. So I actually in Luanda here. I wanted to fly to it. I thought I was going to, and then I saw us coming into the one just here. I don't know if did anyone fly into the new airport? No? Okay. No one lucky. No one lucky. But oh, Congo did. Okay, those coming from Congo, I'd like to hear what your thoughts are. So it's apparently the state-of-the-art, amazing airport. Costs about $4 billion, just under $4 billion. It's supposed to transport more than 15 million passengers a year, hundreds of thousands of tons of cargo. State-of-the-art, it has lots of automated facilities, and it was built by the Chinese. And it actually took 20 years to build. I think that's another interesting story, but we're not going to delve into it. But yeah, built by the Chinese. It's anticipated that it's going to be a new, regional hub. They're expected direct flights to Guangzhou so that you can do a lot of trade with China. So huge opportunity for the country, huge opportunity for Luanda. But what happens again if this US-China tariff war escalates? What does that look like for the country? So you could end up in a situation where, let's take the extreme, where it's escalated to such an extent that the US decides it's going to enforce sanctions on China and its trade partners, right? Or just on China, forget trade partners, just China. So what happens there? This was partly funded by China, so even paying back your loans will be a problem, right? And then, with a lot of these Chinese loans, I haven't read any of them, but, there are lots of stories about how the terms are very difficult, right? So that would be a serious risk for the country. Also, all these hopes and dreams, right, the plans, obviously there's a return on investment for such an expensive airport. If those sanctions come into play and then you can't get the volumes that you were expecting in this airport, that could become a serious risk to the economy as well. Or even if you're thinking about the airlines, the new planes that have been ordered, in the anticipation of all of this increase in volume, that would also be a serious risk to them. So lots of risk there, lots of uncertainty. Again, I'm not trying to be the angel of death and gloom, but it's very important to think through these, and with risk come opportunity, right? So think through, make sure you have plans in place. I've mentioned the whole issue of Egypt with wheat, but at the same time, I heard Ethiopia had a surplus of wheat. If you have a regional hub, maybe you can broker between the two of them. So there is risk, there is opportunity. But I just want to make sure that you have all of this in mind. And of course, would also impact insurance in terms of if there was any contracts or anything that you had bought into with these. The next item I wanted to talk about, this can get controversial. I'm Switzerland. I'm just here to talk about the risks and opportunities. I'm not choosing a side. So there's local political instability in Africa, which it can impact insurance, both in terms of operational risks, right, if you're based in these areas, but also in terms of actual insured risks, to the extent that it's not excluded, but also there are risk pools that cover some of these things in terms of riots. So you can speak to the South Africans. They have Sasria, which has experienced a few losses. So they'd be able to tell you a bit about risks when it comes to political instability. But there have been a few coups that have happened in particularly Francophone West Africa in the last few years. And so people on both sides. So if you're watching these countries and you're seeing that they're having development, some people are seeing it as very positive. Development, they're developing the country, new roads, new infrastructure. This could cause other countries in the region, particularly the Francophone ones, to follow suit, right? Oh, look, they've done it for them. Their countries are prospering, we can too. So that could lead to a catalytic effect or a cascading effect across the African nations. So that's actually something important for us to monitor. I think within Africa, we're very familiar with election-related tensions. Last year there were about 19 or 20 African countries that had elections. So we're familiar with this. But it's important to monitor. And again, it does present an opportunity if you operate in like the political violence and terrorism risk space or insurance space. But yeah, all of this can impact insurance, both in terms of actual insured business, but also operational risk for your companies. Okay, so the next item I want to touch on is climate change. And I think this will be touched on quite a bit as well. But, we know the statistics. Africa is expected to be one of the most impacted continents due to climate change. We're expecting increased extreme weather events, rising frequency of natural disasters. All of this have a direct link to insurance. And I think what is important for us to monitor, there are two things. So first of all, for in my view, is making sure that we have the right data, right? So to be able to respond well to these things, we need to have the right data. I personally have tried to track some of these insured weather events, and it's very difficult. And one of the reasons is that we're not correctly coding our claims. So if you look at a developed insurance economy, they tend to code their catastrophe claims. So when a big catastrophe happens, there's a market a claim code, and that is given to everybody, and everybody will put that code against that catastrophe. And that helps you to monitor, it helps you to monitor catastrophes over time, it helps you to respond to them, and it helps you to ensure there's enough insurance as well. So in Africa, we have lots of economic losses as a result of these catastrophes that are not insured losses. So there's a huge protection gap. And it's really important to make sure that even if we want to address that, we have that data to be able to follow through with that. So I think what I'm trying to do here is encourage both the industry and the regulators to make sure that we are tracking this data, get the catastrophe codes in place. I know that some regulators have tried, but it's also up to the industry players to make sure that you are following through and actually coding that data. So data is important. I'm an actuary, I love data, I love analysis, but I can't do analysis if I don't have the data, and we can't respond if we don't have the data. So this is something that we should expect should be an increasing risk across sub-Saharan Africa, and let us start responding to it now. The next one is in terms of health risks and infrastructure gaps. So again, COVID has played a part in to expose these gaps a bit. I think everybody remembers a few years ago what happened there and how we had to respond. It also exposed some of the weaknesses in health systems. It did also expose some of the good things that Africans were prepared for, but some weaknesses were exposed. And it's expected that new pandemics are going to become more and more frequent. We know about monkeypox at the moment that's being monitored, but we're expected the world is just waiting for the next pandemic. And it's important that we have the infrastructure in place to respond. And also for insurance, this again results in direct insured losses. It results in operational impacts from your for your companies as well. And you know, I think this is one of the places where it's also important for public and private partnerships, because in the area of health risk, it has been shown that, like, in the long term, if you're addressing it earlier, if you're having the insurance products in place over the lifetime of a person, it's actually more likely that their medical costs will be lower over their lifespan if there's early intervention. So I think this is another area of risk that we should be monitoring. Data would be important here as well. Make sure that you have the right systems to gather that data so you can also respond in the appropriate way. Okay, so I'm a general insurance actuary, not necessarily life. So this is more of a life topic, but I thought maybe I'll just add one in there just to check the box for everybody. But an important thing to note, and this does apply to general insurance as well, is that with risks that emerge, people's behavior does change. So when you're thinking about your risk horizon, when you're doing horizon scanning, don't forget that policyholder behavior and also insurance company behavior does change. So the example given here is that of rising interest rates. So as interest rates rise, more and more people, the surrender rates of your policies will increase because people have other opportunities to make money, so they'd want that money back so they can invest it elsewhere. So it's so this is just here just to remind you that policyholder behavior changes. Also, insurance company behavior changes as well. I think if you look at the paper that I was referencing, it talks about how insurance companies are moving more to alternative assets rather than the structural ones. So that also increases the risk. So it's just important to make sure that you're keeping that in mind when you're doing your scanning. No emerging risk presentation is complete without talking about digitalization, AI, and cyber risks. Actually, all the pictures in this presentation were created using AI. So AI can help you gain efficiency, right? Help me with this presentation because I didn't have to search for all my images and I didn't have to think about copyright. They're all created. Hopefully you will not find another one like this, or they've copied me. But yeah, so AI can make things more efficient. But with that, there are also rising risks. So there's the risk with bias, right? AI can be biased. It might be unfair with those biases inherent, and that could bring up legal risks for you, right? People could be disgruntled. It could also be an ESG thing, but it could bring out legal risks for you when there's a bias. And also, you as a company, knowing that you are limiting certain, and it's usually like the people that are already vulnerable that are affected by this, that would not be that would not be wise for you to do, and it's also not good for you as a good corporate citizen, right? And then with all of that again, so with AI, you need data, and data is a theme here. With AI, you need data, but with that, that also comes with data protection challenges. So within Africa, a lot of countries have been bringing up the new data protection legislation. And I think over the last few years and into the next few years, a lot of them are now implementing and enforcing. So as companies, we have to make sure that we have the right processes in place to address these data protection challenges. But also with data is king right now. That also brings around cyber threats. So make sure that you have the right systems in place for that. But on the opposite side, that is an opportunity on the insurance side to offer cyber insurance, but just make sure you know what you're doing, because cyber insurance is a very complicated product. I also touch on just one story here with AI and cyber and the legal implications. So I've heard of like a group of lawyers in South Africa that they're facing legal issues because they used AI for their legal defense, right? So you know, there are many issues that can come up here. I mean, like I said, I use AI for some of these images, but just make sure that you are also inputting your intellectual capacity, because it does hallucinate as well, and loads of risks associated there. Just wrapping up with a couple more relating to regulation. So Takalani talked about IFRS 17 and 9 earlier. But you know, we have implemented, but there's still many risks of involved in understanding the financial statements, and also the new, and I'm sure he's going to talk about this, he said he's talking about this tomorrow, but the IFRS 17 as a reporting standard does not include some elements that maybe as insurance professionals we would have wanted to see. So for example, IBNR is not shown in the standard IFRS 17 balance sheet, and that's something that's very important as an insurance company, particularly non-life, to know. And also just in terms of understanding. So I was speaking to some actuaries in Ghana a few weeks ago, and they're trying to wrap up their year-end reporting, and a lot of them were complaining about the huge swings in their figures, the IFRS 17 figures. And they were like, we think it's because of discounting, but we have to now dig in deep and figure out what's going on. So as interest rates have changed, particularly on the life side, because the discounting period is very long, it's impacting the results. So all of that has to do with understanding, and actually it's going to take us a few years to really know and get a feel for these numbers, and capacity building along the space will be very important. The next regulatory item is with respect to ESG. I mean, we touched on a few ESG points, including addressing the protection gap, but there's a couple of things just to keep in mind. I think a couple of the presenters have already talked about African solutions for African problems, and this is extremely important for ESG. I'm hoping I'm preaching to the choir here when I say make sure you are tailoring your solutions to the African problems. I think particularly when you have international investors who might be requiring certain things of you, they might be telling you what to do. We've got IFRS S1 and S2 sustainability regulations that are coming in as well. So I think you're going to be hearing a lot about this in terms of expectations, but just remember that Africa is different, right? I personally think the social element is really important in Africa, that you make sure that you're keeping that in mind. You know, if we go back to the climate change example, for many developed economies, they're talking about climate change in terms of, are the insurers liquid enough to support that? Are the insurers making sure the exposures are not concentrated? Are the insurers charging enough or not charging too much because they have lots of issues here? But for Africa, it's more about, are people insured? It's not, oh, is the insurer protecting themselves? Are people insured? So that's something that we need to pay attention to. And then also just remember, you know, I always go back to this example, like, of electric vehicles. I hope, again, I'm preaching to the choir, that we're not going to see anybody coming to say we're insuring only electric vehicles when you live in an economy where power is an issue and people are running on generators, because then you're going to have that thing. I don't know, there's been a picture floating around social media of an electric vehicle with a generator attached to it. So you're going to have that problem, all right? And we don't want, we should be coming up with our own solutions that make sense. And for me, within Africa, social is a very important element that I think gets missed or isn't as important elsewhere, that we have to pay attention to how it's impacting individual lives. Okay, so this is one of my last slides. So one thing you shouldn't forget in thinking about potential emerging risks is interaction and amplification of risk. So risks are interconnected. I've talked about how globally everything's connected, but even in the risk space, risks are interconnected. So if we take the example of climate change within a country, so you'll have lots of people who are now displaced, maybe because of increasing floods, they have to move from the area, they're not insured, so they're starting again from fresh with even less money, right? They've lost everything, they're trying to start again. Add to that the macroeconomic impacts within an economy, where people's disposable income is it's not going as far as it used to. They're being squeezed, right? So you've just been displaced from where you are. Now you're being squeezed again. What's going to happen? People are going to get angry, protests. We talk about civil arrests. That, you know, so it's all connected. So I think just bear in mind that when you're thinking about emerging risks or doing your horizon scanning, think about the fact that these risks do interact with each other. And then this is my last slide. So it talks about what supervisors can do today, but this applies to insurance professionals as well, because you won't, just because your regulator has not installed or initiated a regulation does not mean the risk is not impacting you. Risks don't sit around and wait for regulators. So make sure, as the insurance industry, you're also paying attention to this. So the first one is focusing on emerging risks. We've just gone through various risks that are emerging within the continent that you should pay attention to. And like I've said, there are many more, and also the way risks impact your organization or your country might be different. Every country, every organization is different. The next one I want to touch on, I've specifically not used the word ORSA in my presentation, but it's come here, ORSA as an own risk and solvency assessment, because in effect, looking at your emerging risk is part of an ORSA process. But now in terms of the solvency, again, I think Takalani was talking about it earlier, so I believe he'll be touching on that a bit more. But make sure that you are stress testing what you are looking at. And what do I mean by that? So you've thought through the impacts, you've thought through some scenarios, but make sure you have figured out or tested what that looks like on your balance sheet. And also from a regulatory point of view, encouraging or requiring specific stress tests or certain stress tests or certain stress testing principles from the industry is important. You know, when you look at when you speak with the rating agencies and those familiar with rating processes, they talk about how the difference between people that are good at managing their risks and people that are just poor at managing the risks in terms of how they classify them is this stress testing, because that helps you understand how it's going to impact your business and also understand how where you need to focus your energy so that you can put in place risk mitigation solutions to prevent these issues from impacting you severely. Right, you might not be able to prevent the issues that we've mentioned, but you may be able to protect your balance sheet. Improve data awareness, something that I've mentioned. I've talked about claims coding for large cat risks, but there are other things that could be done, even from the perspective of IFRS 17. If there are certain metrics or measures that IFRS 17 is not giving us, don't be scared to keep them on the side, you know, because it's important. You need that to be able to manage your business. Support ESG integration. I've talked to that. ESG is something where you can't regulate, you can't be so prescriptive in your regulation, but I think it's something that you can set the principles of how to go about this. And again, to the industry, don't sit and wait for your regulators to tell you what to do. Start now, or if you haven't started already, and make sure you are thinking through your business and thinking through each item as it is individualized. Promote integrated risk thinking. I talked about how risks are interactive. They interact with each other. Don't think of things just in silos. Think about the different ways that risk can interact and affect the industry. And then the last one, foster cross-border collaboration. I think Honorable Secretary of State did touch on this as well, where he talked about parametric insurance. So some of these insurance products, I'm not saying they can't be done at a country level, they can, but it does help to have regional bodies working to address some of these issues. There are a few examples of how parametric insurance products being implemented across Africa have been quite successful and have also helped to close the protection gap. So I would encourage things like this. Okay, we have lots of African professionals from different countries speak to each other, foster collaboration, and let's see what we can do to make sure that we're making the African insurance space more collaborative and also protecting those that are not protected. That's the end of my presentation. Any questions? Thank you.
Has anyone got any question? Yeah, we have a question right there. Please, we can lead to stand up. Introduce yourself before making the
Okay,
question.
thank you. My name is Hassan Bashir from Africa Development Bank. Well, very nice presentation. On the last slide, on the last 2 points of the last slide, perhaps, Yvonne, you could talk a little bit more from an actuary's point of view, what those kind of, integration and collaborations across border could have on underwriting and the diversification of insurance portfolio. Thank you.
Okay, thank you. So you're talking about promoting integrated risk thinking and fostering cross-border collaboration. Okay, and I just want to make sure I got your question clearly. You want me to talk about how this might assist in developing the insurance products in the insurance industry?
Whether it can influence diversification of portfolio and, technical underwriting results.
Yes, okay, great. I mean, I think it's not just those two elements that would help, right? I think for me, I think the data awareness is also very important, right? So having again, I'm biased because I'm an actuary, so I'm going to talk about the need for actuaries, but having the right professionals in place, like actuaries, to be able to analyze your data and see how the risks are correlated and help you also go into the various insurance products. Because you have to understand, first of all, maybe how the insurance product will affect your profitability, right? You might also want to know how two different insurance products are correlated. So, for example, maybe if you're into the property business and you have a significant exposure in one city, and you're insuring both motor vehicles and maybe commercial buildings, and there's a significant catastrophe event, huge floods, I might even throw in some sort of hurricane or cyclone that's destroying buildings. So you will be impacted from both elements. You're going to get high claims on your from your motor book. You're going to get high claims from your commercial property book, and that it could destroy an insurance company if you are not ready for it. Right? Make sure that you have done these simulations. Make sure that you are holding enough capital, but also, as he mentioned, make sure you are diversified. So that's why you might not want to insure all the risks in one area. You might not want to just be within property, maybe do something that's within professional lines or something different, or make sure you move towards the coast and are doing some marine or something, you know. So try and make sure that so it's important to look at these various risks and then make sure that you diversify your portfolio in order to address them. And then I guess maybe I'll just touch quickly again on the cross-border collaboration. So that's also why regional players can also be helpful in this respect, because what's happening in one country might not impact what's happening in another country. So when you're pooling the risks, you'll be able to have enough capital to cover the insurance claims that are coming through at different points in time from different areas. So hopefully that addressed your points. Thank you. Any other questions?
Thank you, Yvonne. So, with
Please, we
regard
kindly ask you to stand up. Please.
Oh, I'm sorry.
Yeah.
My name is Leboha Mulezani from the Central Bank of Lesotho. With regard to integrated risk thinking. So with us supervisors, when we develop the capital charges, we consider the risks that an insurer has. My question is, when it comes to this issue of integrated risk thinking, are we saying now we are going to come up with new risk taxonomies so that we are able to say, classify credit risk that is mixed with market risk and then call it a certain type of risk and then issue a capital charge on it? Or how would we go about it? Because the mixing of risks would be quite difficult in a practical sense when you are a supervisor and you are trying to attach a capital charge to the risks. Or will we consider the risks in an integrated manner, but when we are developing the capital charges, we now separate it? So what is the best way to go about it?
Okay, thank you for your question, Lebohan. So in terms of I think your question was multifaceted. So in terms of the risk, first I'll start with the risk taxonomy. So in terms of risk taxonomy, I don't think you need to change your risk taxonomy. So this is more about correlation between the risks, or how the risks interact with each other, rather than creating a new risk. So risk taxonomies, I don't believe, have to change. But in terms of how the risks interact with each other and how it relates to capital, so usually when you aggregate risks, the sum of the aggregate is less than the sum of the individual parts, because you get diversification. And he asked about that earlier, right? So because, and that happens because you don't expect all the risks to materialize at the same time. So I guess I completely agree with you. It is actually very hard to to incorporate diversification correlations. It can get very complex. It can be done, but it can get complex. But I guess the benefit for a regulator is incorporating diversification will actually be reducing the capital required rather than increasing it. And regulators are usually trying to make sure you have enough capital. So I would actually expect the push to incorporate diversification benefits to be coming from the industry, and I'd expect them to also be able to be recommending solutions as well to you. But that's what I'm saying. So from a regulatory perspective, the diversification actually just makes the target lower for everyone else. And that actually, the regulator is making sure that you want to make sure that you have capital above a certain amount. So it's actually, it's just helping. It's actually helping to make things easier for the insurers rather than for the regulator. But there are ways that you can incorporate diversification benefits. I think I'm not familiar specifically with the Lesotho solvency basis. In some countries, it's not recognized at all. In some countries, it is. So what I would suggest within your regulator, I would suggest that you do seek or engage some actuaries to make sure they help you with your diversification formula. But there are ways to do it.
This is the last one, please. Go ahead.
You can make your question, please.
Okay. Yeah, good afternoon, everyone. It's Pumi from South Africa. Just a quick question on your emerging risks. So, as regulators, we usually encourage the industry to start incorporating climate and cyber in their strategy. But I see you've included there as part of the emerging risks? Should that not no longer be, are those still emerging risks? Because shouldn't you, when you're running your stress testing for your OSA, be things that you already incorporate into your risk analysis? Thanks.
Thanks. That's a very good question. So I did mention that it does vary by region, company, etc. I think you mentioned you're from South Africa. So in South Africa, with respect to climate change, I think your experience is very different from the rest of Africa. So in South Africa, when there is a catastrophe, loads of the losses are insured. Whereas in other countries, when there is a catastrophe, a significant amount of the losses are not insured. In fact, it's only a small proportion. So I think your experience is a bit different, and maybe you have the data and your incorporation of climate risk into what you're doing is in a different level from other people. So I think that's important to bear in mind. Cyber is constantly changing. So cyber, I do expect people to have cyber on their risk registers. But in terms of emerging, it is constantly changing. And then AI, I grouped AI in there. AI definitely is not something that people fully understand right now. I would even say that, I don't know, amongst the insurance professionals here, do your companies have an AI policy? Probably not, right? I was in a meeting yesterday where Read AI meeting notes just followed me in there and I didn't even know, do people have policies on that? So I grouped all of that with cyber. So that's definitely changing, and I would classify it as emerging risk. Maybe in your jurisdiction, you might have it as, you might not classify changes to current risks as emerging risks, I'm not sure, but I think of changes to current risks as emerging risks. Okay, I think that's me done. So thank you very much. Have a good day, everybody.
Thank you, Yvonne. Let's now hear the voice of the Angolan industry itself.
For now, I'm pleased to invite Mr. José Araújo, Executive Director of Association of Insurance Company of Angola, to reflect on the role of insurance and driving economic growth, resilience, and stability. Please, welcome to the stage. A round of applause, please.
Aqui é para avançar, aqui é para recuar. Para lá. Já? Só um momento, vamos trocar.
Okay, good morning, everyone. I'm sorry, I'm going to speak in English, so my Angolan colleagues, I hope that they are not mad about it, but when I was invited, I asked João Vitorino, do you want me to speak in Portuguese, English, or French? And they said, I prefer English, so I'm going to speak in English. First of all, I want to thank you, Ms. Filomena Manjata, for the invitation. Yeah, I'm very proud to be here representing ASAN, is the Association of Insurers in Angola. For those that you don't know, we represent 96% of the market. And just one thing that I want to say just at the beginning is just that we have a very, very positive cooperation with ARSEG. We work very closely every day. And so this is one of the good things that we have here in our market. One thing also in terms of introduction, I began to work in insurance in 1983 as a regulator. So just to know that, to note that I was on your sides. I know what it is to be a regulator. I was inspecting insurance companies since 1983 to 1985. At the beginning, I recognized I didn't like very much the job because it was an auditing job, but I learned a lot. So it was the best school that I could have was to work at the regulator in Portugal. Then I went to the Association of Insurers, what I'm doing here now in Angola. Then in '88, they invited me to create a life insurance company, and so I went to the insurance market. So, and in terms of formation, just all the people that came here before me, they're actuaries. I'm also an actuary. So, but what I always say is that I did a master's degree when at university then because I thought I would be an economist. But then my thesis is about pension funds because I was already working in insurance. And then I did a post-graduation in actuarial sciences. And in practice, I just worked a little bit like a consulting actuary. But basically, I worked like a manager. And what I always say is that it's very important to know how the actuaries do what they do so that we can evaluate their work, you know. So I always say that, for example, a few years ago, we had here a meeting and you had a Brazilian friend. Then someone asked him how many actuaries should have an insurance company. And he said 80%. So I don't want to exaggerate, but 5% it would be good. So coming back to this presentation. Okay, so this is the title that was proposed. Of course, I was invited 1 week ago. I had 4 days to do it, so I didn't have, frankly, enough data from all the countries so that I could do some cross-border comparison. So what I decided to do, it was something that is to speak about part of the market that I know. So the idea is, this is the agenda, to speak about the main milestones, a little bit about the history of our markets, the evolution between 2009 and 2024. Most part of numbers are until 2023 because we still don't have the numbers for 24, but for insurance we have. Then I have some international indicators and then some concluding remarks. Coming back to our history, this is just history. As Mrs. Filomena said, we are celebrating 50 years of independence of Angola. The independence was on the 11th of November from 1975. In 1978, ENSA, it's a public-owned company, was created, and they aggregated all the assets and the liabilities of the 26 companies that we had in Angola before the independence. Then, in 1988, we approved the creation of the pension funds. This is curious when I was looking at this history. Before the law for the insurance companies, we had a law for the pension funds to regulate their activity. Then in 2000, there was a law to open the market to private insurance companies. Then in 2001, the first private insurance company was authorized. Unfortunately, it's not working anymore for several reasons. Then in 2001, there was also a decree. Sorry, can I have the portable? Sorry, because I must look at the slide because and I don't see it from here. I don't see it there. So in 2001, we had this decree 601 that regulated the reinsurance and co-insurance here in Angola. And there was something very important is the decrees that there were created some special co-insurance regimes for the oil and energy, diamonds, public sector aviation, and agriculture. As you will see later in the numbers, this is a sector that has a big weight here in Angola. Then we had another decree in 2003 to regulate the activity of the insurance agents and brokers. Still in 2003, we had a new law to approve the constitution of pension funds management societies, because the pension funds, as I think that in most part of countries, are managed or by life insurance companies or by specialized entities. And in 2004, there was a decree to approve the organic status of the ISS. It is the predecessor of ARSEG. Then in 2005, we approved the legal regime for workmen's compensation insurance, including labor accidents and professional diseases. For example, in Portugal, this This branch doesn't include professional diseases. This is the state that covers these professional diseases. And in 2009, we approved the civil liability motor insurance. And so in 2010, our market had a boost because of this new law. And we gave here a jump of 12 years to the law of 1822 that, sorry, something here that was not. Okay, I still have this. Okay, then in 2013 we approved another law approved the organic states of the RSEC. Then in 22 we had this new law that regulated insurance activities in Angola, and the regulated law from 2000. Main innovations: increased powers of the regulator and defined clearly its role. Introduction of governance rules about fit and proper, risk management and internal control systems, definition of relevant management functions, risk management, compliance, internal control and actuarial. Just to say that this was very, very important because we had already 4 or 5 companies that were went bankrupt during this process, and because we didn't have this type of common rules, so this is very important for the management of the insurance companies. Then this law also allows foreign insurance agencies to operate in Angola and national insurance companies to open agencies in other countries. Then other important features of this law: the creation of microinsurances and microinsurance specialized companies. Now we are discussing the regulation of this law. Centralized regulations about reinsurance and coinsurance, created clear procedures for the case of potential insolvencies, increasing the powers of the regulator, and centralized definition of possible misconducts and the related penalties. So there were several laws that were now introduced in these new laws. So we don't have several regulations, we just have one law that is important. Then in 2024, last year, we had a new law about insurance mediation brokerage. Main innovations: bank insurance. What happened before is that the laws about the fiscal institutions allowed them already to sell insurances, but we didn't have in our insurance regulation any rules about this. So now the banks should be registered as collective agents. Of course, they go to BNA. It's their National Bank of Angola first to inform them that they are going to sell insurance. Then they will register with RSEC. And there is a limitation that is, for us, it's something that is now in law. We hope in the future we will have some kind of evolution. Is that we have a limitation for individual clients whose products should be connected to a bank products. As I will show later, there are lots of countries where 50% or more or less of the premiums are insurance, and 90% of these premiums are financial products, and 80% or 90% of these financial products are sold by banks. So when we look at our objectives and we want to improve our insurance penetration, we need the banks for life, and of course other insurances. But so we hope that in the future this law is adjusted. Of course, we are basically selling now through brokers and agents. This is our main channel, and also through banks. And the banks have a big potential. Just to tell you, 2 days ago I was speaking with one of my colleagues. He works in an insurance company that belongs to a bank. He was saying, I have 180,000 clients. But the bank has 2 million, okay? So there is a big potential that we should explore with the banks, So here, for example, another number about agents. When I arrived to the insurance market in Portugal in '83, we had something like 85,000 agents. Then, so there are lots of agents. Some sold 1, the other 2, other 10 policies, other 20. but then the market evolved to the professionalization. Now they have around 10,000 agents in Portugal, okay? So, but this is a process. So we are investing, a lot of companies are forming agents. We have now officially more than 3,000 agents. We'll maybe, expectedly, we would like to have 10,000 or 20,000 in the next years. But if we want to develop the business, it is very, very important, this relationship with the banks in Angola. Another thing that was new in this legislation, and sometimes I think I already understood that no one looked at it in detail, is that now, and this is a tendency that in Europe since 15, 20 years ago, all the people that are connected to the process of selling an insurance policy shall have an adequate formation. Okay, so this is something new, because, for example, if I was an employee of a broker, I didn't have any obligation in terms of formation, you know. So I just had some information from the broker, and then I could work with him. Now, if I'm selling insurances on his office, I must have an adequate formation. And so this is what will happen with the brokers, with the agents, and also the banks. So we must have in each agency something with this adequate formation. This is the idea. Then next steps, now coming to the next steps, is to, now we are preparing, and with ARSEG, a new accounting plan that is supposed to be approved maybe during first semester to implement in 2017. This accounting plan will include all the IFRS, excluding IFRS 17. We are still very far from thinking about IFRS 17. As we heard already today, it is causing lots of complications. In Europe, there are countries like Portugal that all the insurance companies had to implement last year, like IFRS 17. It was a mess. In France, they were more clever. Just the companies that are in the capital markets, they have to implement IFRS 17. And just to tell you, 3 years ago or 4, I did a course with the Actuarial Institute of Portugal to understand what was it. And my conclusion my conclusion was, and I said to my colleagues, in the future, to understand all the accounts of an insurance company, you must be an actuary and specialize in IFRS 17, okay? So, and this is still to prove which is the advantage of IFRS 17. And some people say that they think that in the next few years they will revert. Okay, so we'll be looking at it, all the international evolutions, but we are still very far to think about it here in Angola. And even also in the implementation of this new accounting plan, what I always say to the companies, more than adapt to the IFRS, this is not a problem. What will give us lots of problems is to have a detailed analytic accounting system that most part of companies still don't have. So in the next years, they must work a lot in this. And we need this type of information to evolve for an economic risk-based approach solvency system that then we'll begin to study after this. Maybe it will be something like in Europe. Maybe it will be an adaptation like in South Africa. We'll see. But first of all, we have to have data, because the liabilities will be calculated projecting cash flows. And to do this, you must have this analytical accounting data per product, so that we can project income and cost and all those things for the future. We must do then quantitative impact studies to analyze which is standard formula that we will have here. You were speaking a few moments ago about the charges of capital per risk. This is what is the caliber the standard formula has. It has for all the risks that companies face, they calculate the charge of capital. So we must then do some studies to do which is the charge of capital adapted to Angola. And then, of course, then we will implement the system when we are prepared for it. Now coming back to some data. This is data about the economy in Angola. I use here some data that last year it was a an economic journal here in Angola. They were celebrating 15 years of activity, and so they published information about the last 15 years in Angola. And so this is their data. And just for us to have an idea what was the evolution during these 15 years. What is on this last column is the compound annual growth rate so the oil product, national product, grew at a 18% rate. The non-oil 19. Totally, it was more or less 19%. It was the annual compound rate during these years. We had an inflation of 17. So because there is a little gap, so we grew a little bit in real terms. The population had this type of evolution. We were 22 million people in 2009, and there were 36.8 in 2023. So the creation a growth of 3.5% per year, and GDP per capita just grew 14%. Okay, so it was under the evolution of the product because the population grew a lot and under the inflation. So this is the macroeconomic data about the last 15 years in Angola. Then just in some detail, we had a period of accelerated growth between 2002, when the peace agreement was signed here in Angola, and 2014. Then in 2015, the growth was already very small, 0.9%. Then we have 5 years with negative growth, and then since 2021, we came back to positive growth in the economy. The exchange rate was stable until 2017, and then we had serious devaluations in 2018, 19, and 20. And after we had appreciations of the Kwanza in 2021 and 2022, and another big devaluation in 23. Just to have an idea what it means, since January 2010 until December 2023, the devaluation of the dollar was around 400%. So just this is just our macroeconomic environment. So this is where companies operate. Then we still have a big external deficit, namely in agricultural products, and the devaluations are main reasons for two-digit inflation. As I heard today, it's normal in Africa having two-digit inflation. It's not so happy, so normal in Europe and United States, all those countries. But here we have this problem of we have an imported inflation, and then and these evaluations don't help us. In terms of insurance, this is our data from ARSEG from the 2009-2004. The premiums grew at an annual growth rate of 15% per year during these 15 years. This 16 in this case, because I have already data from 2024. We have more 11 companies than we had in 2009. And the penetration rate reduced because we have been growing, but still always under the inflation rate. So this is, we don't, for the moment, we still didn't increase our penetration rate. This is then we have all the several lines of businesses and the shares and the claims ratios. The main the main branch here is health. And then we have oil and energy because of this co-insurance that I already spoke. Then we have workmen's compensation and auto, and these 4 branches are 71% of the market. Then besides these, we have the other property manager and the fire natural hazards more or less with 10%. So we have already 80. And then there are other branches with less weight. In terms of claims ratios are okay in global terms. Of course, there are some lines with higher claims ratios, like workmen's compensation, health, and auto. These are the highest claims ratios. The oil and energy in 2023, we had a a much higher claims ratio, but now it's stabilized on the 10%. Globally, it's okay. Just one note. A few years ago, I was hearing, it was a manager, he's a Spanish. He has experience from Europe, Latin America, and Africa. And he was saying that what is normal in more advanced countries is that what we give back to our insurers is more or less 60% of what we receive. In less developed countries, what we give back is around 30%, okay? So this global, of course, we have differences per branches, of course, but so this around 30-something% is what is normal. I don't have the data from Africa, but in most part of countries should be something around this between 30 and 40. In other countries, Europe, the claims ratios are much higher. Just to tell you, I already in Portugal, I saw already claims ratios in auto and workmen's compensation over 100%. Okay, so the markets are very different. So this is something that I already said. These three branches, oil energy and workmen's compensation. In motor, motor it's not there, but should be there. It's 71% of the market. Health is very popular here because we have a public system that does work so well. Then the oil energy, it's a co-insurance, as I told you. It is premiums are more stabilized in dollars, between $90 and $100 million. So the fluctuations each year is because of the devaluations or appreciations of the kwanza. This is what. And then we have the life. Now we saw life growing a little bit here in Angola, but we are very still dependent of one insurance company, one product. There is one company that had a product related to consumer credit in the bank, and they represent 40% of the market. So it still does not reflect the evolution of all the companies. You know, this is a special case that is influencing all the numbers. We have a problem that we still have one characteristic of our country. We still have auto and workmen's compensation with penetration rates under 20%, and our SEG is helping us a lot with, speaking with the policy and the Ministry of Labor, so that we can improve these ratios in next years. And the highest claim ratios, as I told you, it's in health, workmen's compensation, and auto. About pension funds, this is evolution in the last 15 years between 2009 and 2023. We have more management entities now than we have what we had in 2020 and 2009. We have more 16 funds, open funds, basically open funds. As we see there, we have now 9 open funds, and we didn't have it in 2009. And closed funds, we have more 6. And so it is, showing that we are having some difficulties in creating new pension funds. The assets grew at this rate. It was good, 41%. And so we have some fiscal incentives, either for pension funds and financial products, life financial products since 2022. And further developments of this market depend. This is my opinion, my personal opinion. This is like someone was saying before. It was not the opinion of Azan. It's my personal opinion. It depends on the evolution in human resource management culture. People in the companies should recognize the advantages of this type of products. Development of capital markets. We are still developing capital markets. This is very important for the investment of the assets of the funds and the financial capacity of the promoters, because we can never forget that a pension fund is a cost for the companies. So even if they want to give it to their employees, they have the capacity of tenacity to finance the liabilities. Some international indicators. Just to tell you that it was, I spent last weekend just around internet trying to find data. It was not easy. I was seeing some World Bank, Swiss Re, Africa Re, Global Financial Development, and others. And then I was looking at the numbers that our colleague from Deloitte presented a few moments ago. Numbers are more or less the same, with the big exception is Zimbabwe. Just to be honest, I even talked to people from Zimbabwe on Monday to try to confirm the numbers. So in this chart from Deloitte, it's 123. Here I have 5%. So it's the only one that is not, it's very far from the reality. So, but this is what I found in the internet. Then what is the idea? Is to compare these penetration rates with then GDP per capita and gross, this is not gross domestic income, it's not correct there. Gross domestic income per capita, because some people say that gross domestic income is a better indicator of standard of living than the gross domestic product. Just to look at the averages of these penetration rates for all the countries is 126 for life and 118 for non-life, in total 245. If we exclude South Africa, the rates are a little lower, 0.89 for life and 115 for non-life. But as you see, more or less 15% in life. And so this is why I'm saying that we must work a lot in life business so that we can reach these numbers, but we need the banks to do it. Then this is just visually just to see that what I was trying to find is if there was any correlation between the penetration rates and GDI, gross domestic income. And we just see, even without doing calculation, then I'll have some calculations at the end, that there is no correlation. There are companies, countries smaller that have big penetrations and other bigger that have lower penetrations. So it is visually we see that the correlation should not be high. Then if we go to life, it's the same thing. This is sorry, before it was, and then this is non-life, even less correlation. Then I resumed here these correlations here in these numbers. So the correlations are very low, you know. So for life, 33% for GDI. Sorry, this is not correct. That's not GNH. It's gross domestic income, 33%, and to GDP is 26%. For non-life, it's even worse. Only 11% of correlation. In the total, 32%. So the conclusions are that there are very low correlations between these data. So penetration rates and GDP and GDI. Non-life lower than life, and better correlations with GDI. Sorry, it's not correct. It's not GDI, it's GDI, gross domestic income. So coming to these conclusions, GDP and GDI are not a good indicator of level and perspectives of the development of the insurance markets. Other factors should be considered. I'm going to speak about some of them, not in a specific order, just the same. So level of social security benefits, it's very important because companies that have very good social security systems, people don't have the necessity to have their own system, their own savings, and invest in life insurance, financial products, or in pension funds or other products. The insurance and providential culture of the country, it's very important that we'll look at each country has an history. For example, I forgot I was saying before about South Africa, and I forgot. South Africa, it's a country with a big and very long tradition in life insurance. I think it was in 87, or I think I already told this story, no? 87, I told the story about rare disease or not? No. Okay, so in 87, as an consulting actuary, I was invited to design a product related to the cancer in Portugal. And they didn't have any data, and fortunately I had some friends, and because of these cross-border relationships, I had called a professor from City University in London, and he told me, okay, we have 1 year, we have some data about cancers. And so with this data, I created this product in Portugal that it was never commercialized, but it was instinct to build the product. Then when I finished to do this, so I'm speaking in 87, someone told me, oh, there is now coming to Europe a new product called rare diseases. Doenças graves in Portuguese. Rare diseases. And it was coming from South Africa. Okay? So, rare diseases is a product that came from South Africa in the 80s to Europe. South Africa always had a big tradition in life insurance, in innovation, all those things. And so, this is not surprisingly that they have 80% or something of penetration rate in life insurance in South Africa. So each country has an history, and people have a culture, and this is very important so that we can develop. Then development of capital markets, very, very important for the insurance companies, and namely in life insurance and pension funds and financial products. It's very important to have developed capital markets well developed. Then fiscalization of mandatory insurances. This is another question. This is another problem. So this is one of, because normally what I say is that first insurance that a person does is the auto insurance, and the company does the workman's compensation insurance, and they are obligatory, and if we know if they are not, they don't have, sometimes they look at it not like a benefit but as a cost, and so we need to fiscalize it. Then bank insurance is very important. How bank insurance is developed in each country, with development of several distribution channels. So are these things that contribute to the evolution of the countries? Then other things that we should consider when we look at countries' lines of business, the country development perspectives, financial capacity of companies and individuals, because if you don't have money, then we have, even if I'm aware of my risks, if I cannot afford it, I cannot buy it, fiscal incentives, etc. So this is what was my biggest conclusion, and we spend a life looking at these numbers, so relating penetration rates to GDP per capita, GDI per capita, and they are not correlated at all. So we must look at other factors to try to explain the evolution of the market, the insurance markets in each country. So, thank you.
Has anyone got any questions? We have only time for 2 questions, please.
Okay, I'm Leboha Muletsane for the 3rd time from the Central Bank of Lesotho. I just want to know, from the industry perspective, how or what are the causes of such low penetration when the industry is growing so well over time? What did you realize to be the main causes of the low penetration? Because from the figures, it seems the industry is growing massively, but the penetration is also going down.
So you're speaking about Angola. What I was trying to explain is that we are growing, and for example, last year we grew 25%, but the inflation was 25.5%, okay? So if the GDP grows more than we grow, then in relative terms we are growing less than this. This is why we are not, the penetration rate is not increasing. So this is now, as I say, pure mathematics, you know. So, but we are increasing it, and people, for example, last year in Angola, we had a decrease in the life business, but non-life business grew at 33%. So we are on the right way, and but all the efforts that companies do every day are still not enough to increase more the our penetration rate. As I told before, it is one of the things that we are finding difficult is to increase the penetration of mandatory insurances, auto and workmen's compensation. And as I told you, RSEC has been very active in trying to help the insurance companies to do this. For example, one thing that something that is discussing with RSEC also, and I saw I was in the Yellow Card meeting 2 months ago. There was some people from Ghana that were saying that they were very successful because they gave access to the database of the regulator of people that had auto insurance through a very simple system with the SMS. And so we are also here studying with RSEC this possibility, because if the police, when he stops a car, if he can go to the phone, send a simple SMS and receive the response if this person is insured or not, it helps a lot his job. And even in Ghana, they were saying to people, if you have go into a bus, you can go and see if this bus is insured or not. So it is an idea then that we are exploring, and maybe we hope it could help us also.
Yeah, we have a question here. Here.
Thank you very much. I've been trying to resist making a submission, but it's good to see so many actuaries making presentations. I think just two issues that come to my mind. One, actuaries rely on data. There's very little that you can do without data. I would love to hear a comment from any of the actuaries here in terms of the continent's readiness and availability of data for you to do the work that you're supposed to do. Because I think this is one of the things that we're really struggling with, not only as regulators, but just as a market. And I'm happy today that we have regulators and market players, if you can emphasize the importance of having data. I think the second question that I have also, as we discuss issues of insurance penetration, is the confidence in our business and in the sector. We will be able to have people taking up insurance policies if we are meeting the promise. And I think one of the challenges that we have as a continent is just trust in insurance and the confidence that we have and relevance in some of the products that we are offering. And I was hoping that I would also hear something about that, especially given that we've got the market here today. Thank you.
Yes, this is a very important issue. People must be confident. But one argument I don't buy at all, is people to say, I don't know what is this, what auto insurance is for. Because what we see in the insurance companies is that when a person has an accident, if he doesn't have an insurance, he's going to try to do the insurance, okay? So there is lots of corruption of people that try to do not, so they know what is the insurance, but it's negligence, it's something, but of course, this is very important, and this is why I mentioned before this problem of the governance rules that we have now. We had a problem, and I saw lots of cases of people saying that companies didn't work. In the most part of the cases, were companies that are already closed, okay? So they were not providing a good service. They didn't have money to pay the claims and all those things, so it was a problem for the market. Now, in this area, because this company is closed, we don't have already this argument, and things are, evolving. But of course, this is very important that people believe in the insurance companies, and companies are going to pay their claims and other things. This is very important. In terms of data, just to give an example from Angola, is that now we are speaking, we already today heard speaking about this parametric insurance. We are just looking at this because we don't have a data here in Angola. Because if you have data about our risks in agriculture, then we would provide the type of products more adapted to necessities of people, of needs of people, okay? So what they want is to receive a claim according to his loss. And with parametric, we are not guaranteeing this. Okay, what we are saying to people, okay, you have this insurance. If the index goes to this level, you receive a capital. This capital is not connected to his effective loss. Okay, and even you can have a loss, and because the index didn't go there, you don't receive anything. So this is technically the problem of parametric products, and this is some, in some countries, some, for example, there is, I think they will speak it today, I think, or tomorrow. In Mozambique, there is a case where a supplier of feeds, he bought the insurance. Then, of course, this insurance affects lots of people, but there is one buyer, okay? Because this is the guy that understands how the insurance works and how it can help him. The agriculture people that are on the fields, they just know, okay, if there is a flood, I lose my seed, this guy is going to give me a new seed. It's okay. But there is not an insured person, okay? There is one insured person, and you must know it very much better than me. There are millions, thousands of people that are affected by this. But just coming to what I was saying about agriculture, what we are proposing here since a few years is that we should create a database that in the future could study other products more adapted to the needs of the agriculture people, the needs to each crop, to each disease, to everything, but we need data. And like it was here mentioned today several times, the actuaries cannot do anything without data. And so this is why looking at parametric, okay, we have this data from how do they call it? Satellites. Yes, sorry, I was not using the word. So you look at satellites, we have this history, but one thing, for example, we did the association with some companies that want to develop a product here. We did several meetings with them, and even for us, actually, it was not easy to understand, Even, for example, to give an example, I'm not going to give names, but the guy that was helping us to develop the product, then we asked them, okay, now give me an example of a claim. And he gave us an example. We are doing the accounting, okay, it's not correct, because you are deducting twice the deductible. So even technicians, international technicians, they do mistakes, okay? And so then we stopped the process for 1 year until the guy understood that he was not wrong, it was not correct. Okay, so this is, for actors, it's very nice and all those things, but for the normal people, it's not easy to understand how does it work.
Thank you very much. Alhaji Kadunabi Ibrahim Lubega from Uganda. And just to follow up from where Dr. Grace stopped, maybe Madam Philomena can help us. Don't you find the 34% claims ratio too low to convince people to buy more insurance? Because I looked at that slide and I saw life, you are having about 10%. I don't know exactly how that can be. And I saw, was it personal accident with less than 1%. And overall, the 34 is too low, because one of the fundamental reasons why insurance companies open is to compensate the people when they have a problem. Okay. If you are paying anything lower than 50%, you are a problem. Or we are the problem. Mm-hmm. So maybe Madam Philomena or you need to help me. as we want more people to buy, okay, we must also do something.
Maybe I can get back to the numbers just for us to understand it. Okay, so for example, as I was saying, the more common insurance like workmen's compensation, auto, health, they have high claims ratios, normal claims ratios, and they are climbing. Okay, every year they are climbing. So, so the other products, life, as I told you now, it is a concession product related, basically, it's 40% of the market with the bank, and there is lots of risk diversification, okay? So it's normal if you have thousands and thousands of insured people, they don't die, every day. So it depends. This is the reality for the moment. And it could be, one of the reasons why it is so low. Maybe the rates are very high. I don't know. But this is problem of the company. The companies, they must know. So workman's compensation, for example, this global rate is influenced by one insurance company, a big insurance company that has a very low claims ratio. But when I exclude this outlier, the numbers are 50, almost 60%. Okay, so the health, it depends on the year, because we are at the beginning of the year. Then throughout the year, it will come to 70 or something like this at the end of the year. And then travel, it's just a small branch. And personal accidents, as you see, also it is a small branch, but with a low. Then in fire, for example, fire in 2013, 23, pardon, the claims ratio was over 100. So it depends, of the flood. That was because we had a big fire, and because the branch is not so big, we had more 120% more or less of claims ratio. So it depends on the years and fire. And this is, for example, this in fire it's negative because it's a question of the provisions that they had last year. They adjusted. So because of one of these big claims, they adjusted the provision for in 2024. And transport, I don't know it is your experience, but normally it's not over 20% of claims ratio, but at least what I have seen here in other countries. Oil and energy, for us it's all 98% more or less of the risks are reinsured. Last year we had more than 40% of claims ratio. Normally, the problem of the oil is that not these small ratios. The problem is that if we have a big claim, it will be very 100%, 1000% of claims ratio. Okay, so it's normal that in the normal years the claims ratio is low, but the problem of this ratio is catastrophes. And then civil liability, 27%, another 8%. So, and in this other, there is a big part of bonds. It's a new line of business appearing here in Angola. And for the moment, we still don't have a big claim, but it can happen anytime.
I think you as an association, you might not appreciate it, because that means the 34% overall means that the biggest expenditure is management expenses. And as a regulator, I want to just encourage my sister to take interest in what happens there. Now, when that percentage goes up, it means we are doing the core business of insurance. People are being paid. So more people will come on board. And to me, that's just an observation.
I understood, but what I was saying to say is that in the normal branches where are normally more claims, the ratios are more or less like this. As I told you, in Portugal, workman's compensation, I already saw 100%, more than 1% claims ratio in a few years ago. Then in Auto also we still had, at a certain time, we had 80%, 85% of claims ratio. So, but this 40%, 60% is normal. Of course, then you must also have your margin to pay your expenses, no? And to pay the brokers and to agents, all those things. So this is our normal. The other branches I told you, they fluctuate more, but it's not unusual. Of course, coming to the future, if suppose that we have the premiums of auto and workman compensation. If we didn't have 20% of penetration rate, if you had 60. So we had these three branches with they tripled their weight. And the global claim, the global average ratio would be higher, so it depends. We are in a process. So looking at this, and as I told you, I began as a, if independent of what you are saying, I began as a regulator. So I look at this always in both sides, as companies and regulator, and so it's not something that is unusual.
Thank you, Mr. Araújo, for your brilliant presentation. We've had a powerful morning today, so now it's time to pause, reconnect, and the most important thing, eat.
Thank you very much, Shalom. Now it's time for our lunch. The lunch will be served on the ground floor, but do not worry, we are just getting started. In the afternoon, still hold with so many incredible things. Just a reminder, the ground floor is 2 floors above, and we have to come back here at 20 minutes to 2 p.m. Please enjoy your meal and try to respect the time. Thank you.
Thank you. Let's just wait a few minutes. We're facing some technical issues. Hello, Elias. Yes, we can.
This is the hard time of the day after dinner. I can see through your face. Please, let's try not to fall asleep, please. Let's try to make an effort to be awake. But tell me, how was your dinner? Was it tasteful? Missy Operi Kapama, how was your dinner? Was
Actually,
it tasteful?
lunch.
Sorry, how was your lunch? Thank you. Thank you. How was your lunch? Operi, how was your lunch? Very good. Yeah, we're glad you like it. Missy, what is my best friend? Vanessa. Vanessa, did you enjoy lunch? Very good. Yeah, we like it. Who else? Who else? Well, what is my another photos friend? Catherine. Right there, Catherine. Did you enjoy lunch? Seriously? Did you take in natural juice? Don't you like natural juice? Okay. Yeah, we can see.
Elias, you can go ahead, please. Yes, you can hear. We can hear, Elias. Not yet. Just a minute.
Sorry, Elias. The slides are still not up yet. We're just waiting for you to start sharing. We'll let you know just now. Yeah, we just want to put you up on the main screen. Okay, you're good to go, Elias.
that people will see value and really content with what it provides. So what are some of the three waves that we are going to see coming in the next frontier? Now, we are coming from a digital insurance, and this is what we've been pushing for, whereby you ask insurance companies, you ask your insurance industry, how do you ensure that your products are driven by technology, kind of making insurance more attractive, and kind of looking at how then do lower the cost of insurance. And digital insurance has been on the rise in a number of markets, but there are two other ways in which we are going to see a lot of movement. And this will kind of create a very dynamic way on how then we are going to regulate insurance, but also even the way the current industry players are going to connect to these two future frontiers. So there's what we call connected insurance, whereby people are not only going to focus on risk protection, but people are going to look at risk prevention. So we've seen a lot of the growth of technology, and that will mean that people will only take insurance for what they cannot prevent. So issues around telematics, whereby if I'm a safe driver, do I really need to pay 5% of the cost of my vehicle? Yet I can use telematics and reduce the cost of my premium as much as possible. Embedded insurance will be something into the future, and this kind of pushes the current insurance industry into a very big challenge, because insurance will be offered by other sectors in an embedded technology. So what will be the future of an insurance company? That basically means that there's need for us to really connect and see how then connected insurance will be something for the future. But also in terms of regulations, if somebody that is offering insurance is not trained in any form of insurance, but they are offering insurance within the product that they sell, then how then do we navigate that particular vein? But the future of insurance will be on generative insurance. Think about AI. Think about issues around machine learning, telematics. So artificial intelligence will move the insurance to the future. We've seen smart technology, smart watches, issues around smart houses. That is all driven by artificial intelligence. Issues around predictive analytics will also be a very key leverage within the insurance industry, but also models will be enabled to learn. So what is the future of work, including the future of insurance professionals, when we'll be looking into issues around generative insurance? So those two elements will be the future of insurance as we kind of still navigate through the digital insurance. Now, that will help us now enable us to address the inclusive insurance goal. If you look at inclusive insurance, this basically encompasses different approaches on how then you reach three levels: the unserved, the vulnerable, and low-income populations. And this is probably in mostly the emerging market. So how then do we enable reach? How then do we enable affordability? How then do we enable simplicity? Now, microinsurance is just a subset of inclusive insurance, because microinsurance will only focus on low-income populations. Now, there are other people that might not be low income, but in one or the other, they are vulnerable or they are underserved. Now, inclusive insurance brings all these three elements together: reach, affordability, and simplicity. So in terms of the strategy, that's a strategy that we might see in the future, and this will kind of impact both the market, but also the regulatory side, is that there's need for simplifying products. There's need for us to ensure that people can easily understand, can easily enroll, can easily claim. So institutions will have to build very simple products. The second thing is finding new distribution channels. So embedded insurance will be quite key. Issues around generative insurance will be key, but also really looking at different aggregators, from telcos to farming cooperatives to banks, to even brand assurance. We are going to see some brands that will be very key into driving insurance markets. Leveraging digital channels and also new insurtech models will be the future? How then do we connect? How then do we serve? How then do we enable low-income customers? But also implementing new business models, new products, and providing them in a way that we are not only thinking about risk mitigation at a scale, but also really ensuring that there is elements of risk prevention and even providing value adds to the customers. Now, how when will this then impact the inclusive insurance framework? We've talked about the strategies that we are going to see. Now, in terms of licensing, many types of insurance underwriters will have to be permitted. So we might see underwriters that are not what we always know as model underwriters, whereby an insurtech will come into your market and say, I want to have a stopgap measure whereby I can underwrite some risks to a particular level. So we are going to see lower simplified capital requirements coming in because these people will be able to address a certain level of risk. Product approval and features will also have to change in terms of they'll need to be a simpler product approval process, issues around product definition, how then do we define the insurance products, but also extended grace and cooling off periods is something that we are likely to see because some customers will not have the ability to pay premiums more frequently and more consistently. They'll have irregular payments. And that basically means that we really need to think about like bridging facilities, premium liquidity facilities that will ensure that, these particular customers will still be served. And how does that really mean to the insurance regulations, whereby you want the customers to pay premiums consistently, but also in terms of, the premium levy and kind of elements. Distribution and intermediaries will also always be impacted. We are going to see alternative distribution channels, and that basically means that we need to think about lighter qualification and training, including those people that are going to provide insurance through embedded channels. They might not want to be taken through a very long, lengthy training process. So how then do you ensure that our regulations ensure that they can get this lighter form of support? Disclosure and documentation, simple documents, disclosure requirements will also only have to change. Will it mean that by somebody distributing the product using a mobile phone, will the policy document be just a text message sent by USSD, and that will be taken in as a policy document? How will that really impact regulations? Premium collections are really applying alternative means. It can be even in form of tokens. We've seen a country such as Nigeria enabling premiums to be paid by waste, whereby depending on number of plastic bottles that somebody has collected, and that is taken in as premium, and that is converted in some form of cash. Claim settlements, shorter claims payment timelines, and complaints handling response will have to be thought about, including the timelines that these particular complaints are addressed. So let me think about a farmer, and this is just a practical example of how then connectivity and digital technology will drive change. If you think of a farmer that is thinking about a bundled solution that is simple, accessible, and affordable, and think about its different pain points across the value chain towards inclusion and food security. So this farmer will not only be thinking about insuring his farm, but he will also be thinking about how then do I have access to credit or financing. So what will be the initial point of contact? So we really need to think about where insurance can play across this value chain. Will it be in terms of quality inputs and mechanization? Will it be in terms of accessing savings? Will it be in terms of ensuring that they are provided the value chain and get ready market for their produce, whereby insurance will kind of embed this particular chain? So the key thing is then insurance will not only be a standalone product. It has to be bundled with different elements that these particular customers will need, over the lifetime towards what they are building their future on. Now, let us think about these three elements: the current, the possible, and the aspirational. Now, if you look at the current needs of a farmer, is that farmers face risks that will lead to food insecurity. And that is all what we know. If a farmer will not get enough rainfall, then there is food insecurity in a particular country or in a particular community. So that is what is current, and that is all what we know. Now, what is the possible? What is the possibility, and where should we kind of take these farmers towards? So we really need to think about improving the livelihood of these farmers. And that basically means that there's need to provide them access to financial services and agricultural services. And when we talk about financial services, then that basically means that there's need for insurance, there's need for credit, there's need for access to farming inputs, access to money mechanization, because by only addressing climate risk, then we are not going to enable this particular farmer towards enabling us to solve the food security crisis. Secondly, climate smart agri practices will be key. So when we talk about agricultural practices, we are going to see insurance companies even extending further and providing climate smart practices to their farmers. Now, what will be the aspirational? Where should we find ourselves to? We need to build a farmer-centric business model. And we're not only going to look at insurance as a financial product, but really building insurance to become a business model and create value throughout the journey of a farmer. At the point of planting, there's need for inputs, there's need for mechanization, there's need for support. Will insurance also offer those particular services just beyond collecting premium? As the farmer moves along the value chain, is there need for the access to credit? Is there need for this farmer to start learning financial literacy issues so that he can also become a saver at the end of the day? So that is the business model that really needs to be connected to a farmer. So then we have to create a future for insurance. And if you look at creating the future for insurance, we can basically divide an insurance company into three areas: the front office, the middle office, and the back office. Now, if you look at it from the front office, there are a number of things that will need to be disrupted. Now, over time, the insurance companies are focused on the growth strategy. How much top line have I grown? Have I really increased my business by 20%, by 30% of gross premium? There's also marketing. There's been usually trying to do a lot of marketing. The distribution channels have the sales and distribution have remained the same. The products and services have remained the same. The future will be on those red boxes. Innovation will be quite important, whereby innovation will not only be done on the front end, but across the insurance office. Then also new channels. We have to create new channels, embedded insurance. We have to distribute using technology. We have to talk to aggregators. So that will create the future of insurance, whereby we kind of move out of the traditional channels to the alternative channels. Now, when it comes to the middle office, this requires a complete overhaul for any insurance that is really thinking about the future. Operations have been quite a big challenge, whereby the business model is really managed by legacy systems. There's need for agile operations, including the technology that will be adopted, and how is the information and data utilized. Most of the time, the middle office does not use the information that they receive. How then do they use data analytics to define insights for the future of insurance, and also ensure that when it comes to the customers that they are onboarding, they really understand what is the next risk that they should be modeling to cover for that particular company, that particular customer. Now, when it comes to the back office, there's a lot of focus on finances. There's a lot of focus on capital management. There's a lot of focus of human resources. And if you look at how the industry is all about the musical chairs. CEO moves from company A to company B, and officers move from company A to company B. So human resources has been something that is their movement and all that. They're focused on the capital adequacy. So most of the time, they're trying to just put their head above the water so that they don't drown along the capital adequacy line, and even really looking at finances. But the future will be on three other things. How are we going to do our underwriting and risk management? Are we going to ensure that we properly understand the information and data that we receive and start doing targeted underwriting that really meets the needs of the people? So there is need for us to really rethink about the underwriting and risk management issues. There's also need for us to think about claims and benefits. How are we paying our claims? How quickly are claims paid? What is needed? There's a lot of innovations that really needs to come on the claims and benefits. Now, assets and liability. There's also need for us to really think about our investment strategies that will not only think about putting this into the green assets, but also the liabilities that we are going to insure. So are we going to start supporting the development of sustainable insurance solutions in the long run? So some of the key considerations for you to take home, when we are developing an inclusive insurance strategy, we really need to think about customers, we really need to think about data, innovation, and risk. And what I'm going to do here is to kind of now break into details on what you really need to do if you are an insurance company, and also some of the insights that the regulator really needs to look at when it comes to companies that is developing the inclusive insurance strategy. Now, this will come from the top-down approach. If you look at most of the companies, inclusive insurance is never discussed at the board level. It's never discussed in a management meeting. It's usually given as a theater, and even if it will be discussed, it will be like 5 minutes discussion. Like, it doesn't really add a lot of value into the business. But from a strategic point of view, there is need for us to start thinking about having a response and really ensuring that the CEOs take a charge of this particular business model. So there is need to drive inclusive insurance, and there is need to really anticipate and respond to the changing markets. The key goal is then the CEO has to drive this. There's need to decide which markets, which countries, which customer segments to target. So that has to be clearly earmarked, but also to prioritize your investments and build capabilities that will ensure that you survive and exploit the changing market. So those are some of the 4 questions that a CEO should be able to answer. Now, if you talk about the risk, the chief risk officer, most of the time they will be like, no, we don't really need to go towards that direction. So the key thing would be how well is risk management embedded in the organization that will kind of provide some comfort in assessing new product, services, and distribution channels. So the issue is not that we are not going to say no to the new products, but assessments to provide insights and to ensure that that risk can be taken. Also, there is need to be anticipate for the black swan events. Inclusive insurance can be also risky, but that basically means that do you anticipate and prepare to address those particular risks from a chief risk officer perspective. Under the chief marketing officer, there is need to transform the organization into a customer-centric innovation organization, more from a product-centric organization. And there are 2 things here. Product-centric organizations will kind of not move agile and quite fast, because you kind of tend to push the products more than pushing the consumer's needs for your product. So in this particular case, then the marketing team must think about customer centricity. The chief technology officer needs to be aware of emerging technologies and start experimenting them within the organization. The chief investment officer also really need to think about how then do we build an advantage. The chief information officer in this particular case, how then do we use data, how then do we take advantage of cost-effective technologies, and even thinking about digital sandboxing within the organization as they move forward. Head of actuarial, I think these are the guys that will always tell you that we cannot price that product. It's not possible. They also need to think about how then do they select and price risk appropriately, and these will be based on the risk appetite. So they have to be included into the game. The head of underwriting, what are the new sources of information, and how can we improve better risk selection and pricing? The claims person, how do we transform our organization into paying claims? Earlier today I had the commissioner of Uganda, Honorable Lubega, really asking a very pertinent question on the claims ratio. Because if the claims ratios are quite low, then does it really mean that is our particular product even meeting the needs of the people? HR, there is need to attract the best talent, the right talent. How then do you ensure that you kind of bring a multidisciplinary goal within the organization and get the right targets, the right talents within the organization? Now, there is a report, and you can scan this particular report. We did a study that really looks at how then we can build the future of insurance using two elements. One is on the market, and the other part is on the regulator. So this tool, this synthesis report, really looks at how the market and regulator can create the future of insurance within the market. Really looking at how the market can innovate and enable partnerships, and even ensure that those particular innovations are supported by regulation. So you can scan that and get access to this synthesis report that really provides very good insights into the future. So kind of ending is, what is the role of FSD Africa, and how then do we support this all goal? So our role is really to design, implement, and invest in catalytic interventions in African financial markets. And here we look at issues around policy development, issues around financial institutions, strengthening financial institutions, financial products growth, really looking at issues around market infrastructure and knowledge platforms, with one clear goal: how do we ensure that we support energy transition, we support increasing climate adaptation? How then do we address the over-economic mismanagement that is leading to a lot of unrest, and even issues around increasing debt distress? Ideally, we look at adaptation and resilience that will be key in terms of building and closing the protection gap, particularly to those particular people that are highly vulnerable, not only to climate risk, but other emerging challenges, socioeconomic challenges that do impact the African markets. The future is that there is need to ensure the environmental benefits delivered, economic opportunities created, but also addressing issues around fragility and vulnerability within the continent. So what we've been doing, and I know most of you have come across the Bima Lab ecosystem, whereby it kind of brings different players within the insurance value chain to support growth of innovation. So innovators sitting at the center, we ask ourselves, how then do we provide the technical capacity? How then do we provide access to funding? How then do we connect them to strategic partners? But also building regulatory barriers, kind of reducing regulatory barriers within these particular markets. Over the last couple of years, this particular model, Accelerator 100 Startups, managed 45 key partnerships, and so far managed to raise $35 million of direct insurtech funding. Over 4 million customers have really benefited out of the solutions created, or 150 insurance products developed, and currently working with 15 regulators in supporting creating a supportive ecosystem. Building a stronger, more resilient insurance market across Africa is the goal, whereby we are looking into driving change and becoming the real change agents. These are the countries that we've so far supported, whereby really working with over 7 regulators to develop regulatory sandboxes, which is critical for the growth of the market. If you are in the room and you would want to be part of this particular ecosystem, do not fear. You can reach out to us as FSD Africa. We've kind of already sent a number of invitations to a number of countries, and hopefully your country will be colored green in the next year as we develop these particular markets. I'll pause there. Thank you guys very much. You can get hold of my email. You can drop your message, really to look at how then we can build the future of insurance markets. Thank you. And it was quite a miss for me not to be in Angola. Thank you very much.
Please, it's time for question. Has anyone gotten a question? Question, please. Questions. Yeah, we have our questioner.
Your questioner. Okay. Hi, Elias. It's Leboha Muletsano from the Central Bank of Lesotho. So my question is with regard to the strategies of inclusive insurance. You had there, I think, a slide. Maybe you could go to that slide. It had two issues. The issue of simplified products, and then the issue of, I think you were saying, products that were comprehensive of or all-encompassing, something like that. But when I look at the two, okay, both would benefit in terms of increasing inclusiveness of insurance. But most of the time, those products that are comprehensive or all-inclusive are not really simple. So how then would you bridge the gap between coming up with products that are simple enough to be understood, but at the same time, a product whereby one can buy one product and get a whole range of insurance services?
All right. Thank you very much for that question. Now, and I'll give you an example based on what I've seen in some markets. When you think about a customer, particularly when we talk about their missing middle, this is a customer that, let me first define what this missing middle is. There are those customers that will depend on the mercy of the safety nets, but government has to take care of them. They might not even have an opportunity to have any form of payment. Now, there are those customers that are just above the safety net, that either they are very low in income and they cannot really have an ability to purchase or to get the right products, because most of the time the products are quite expensive, is out of range. Now, then over and above that, we see where the insurance companies do provide their solutions on. Now, what we've seen, and this is a product that was recently licensed in Kenya by with one of the micro insurance companies. This particular product was providing a bouquet of risks, and it was not kind of defined, whereby, you know, most of the time we'll say that the premium is X for these risks, and if there are so many risks, then it becomes so complex even to price. So what this particular company does is whereby a customer can select the risks that he is aware of or he wants to be covered. Then out of the selection, then he would get a proportionality of the premium that that particular risk that he wants covered would really cost. So in terms of the complexity of the product, we shouldn't think about being product centric, but that's why I mentioned the customer centricity, whereby the customer himself decides what risks he wants to be covered. And from there, he can select from a bouquet. So it's more like a customer going into a supermarket, depending with how much you have, then you collect the goods that will meet your needs. So that's how we should see kind of products being developed, not from whereby you want to think about all the risks, then try to get the name of that particular product, then try to price all the elements of that particular product. That will become quite confusing, quite complex. And what we've seen happening in Kenya is whereby now a customer can, a company basically offers a bouquet of risks, and depending on what benefit a customer would want to get, he will select his risk, the level of benefit that he would need, and then from there, you should get what is the rightful premium that needs to be paid. So that makes it simple from a customer perspective, not from a product perspective, because once we start from a product perspective, then inclusivity becomes a very big issue.
Any other question? Please, we kindly ask you to stand up. Thank you.
Yes, good afternoon, Elias. This is Mdenda from PIA Zambia. I'm speaking from the perspective of a product being customer-centric. From your rule of thumb, do you have any figure where the loss ratio for it to be customer-centric? I'm asking because I saw somewhere, I think here, where they were putting a combined ratio of 51, and I feel 51 is a bit too low, because for microinsurance, customers really need to see claims being paid. So a 51% combined ratio for me looked like it's too low, and it will not be sustainable in the long run. What's your comment? Thank you.
Right. Thank you very much. Yeah, so I'll kind of want to lay two studies that would reflect some of these issues. Now, there was a study that was done by McKinsey, really looking at these two elements, the difference between customer-centric and product-centric. Now, if you look at what we call customer-centric, and let me then define customer-centric solutions. So these would be solutions that will meet the needs of their customers, while product-centric are those solutions that will look at delivering high-quality products that meet the needs of consumers. So the first one is you are currently targeting the needs. And if you look at an insurance company, the need is to, the goal is to basically pay claims. And that's why insurance companies are formed. Now, according to McKinsey, those particular companies that were customer-centric in terms of the way the customer satisfaction was delivered, they experienced 60% more profitability than those that did not have customer-centric solutions. And those companies that were product-centric had a 6 to 9 higher revenue growth compared to their peers. Now, what does that mean? For insurance to really work out, somebody has to test it and know that it works. Now, how do you really know that an insurance product works? Is by getting that particular product, getting that like you're receiving your claims paid. So if a product pays, there's a claim that has been paid, then this particular person will know that surely this particular product works. So what we see is that consumer-centric solutions at the start will have very high loss ratios, and that is what most companies are trying to run away from. Particularly when you tell your board that a loss ratio in the first 2-3 years will be 70 to 80 to 90%, then it will be like, no, you are stopping doing that particular product, and that's how you'll get that as this particular product becomes more beneficial to customers, then they'll be able to see that there is value on those particular products. So what I see is that there is need for us to really focus on customer centricity, and customer centricity will mean that the loss ratio will be high in the first periods of the product, but as more people get into the business, then we are kind of gonna see what McKinsey study states that around 60% of growth will be experienced in the long run towards the benefit of the customers. In fact, I was speaking to one of the emerging insurtechs that is currently doing underwriting, and they were saying, our goal is not to reject claims. We want to pay as much claims as possible. We want these people to learn and test the product so that we can get more people joining and appreciating the value of insurance.
Thank you, Iais, for your brilliant and brief presentation. Please, a round of applause. Sorry, just one question. Why did you laugh when I asked you if you had enjoyed your dinner? Why? But why didn't you ask me, Lionel, what dinner are you talking about? I was talking about yesterday dinner. Didn't you go to that incredible restaurant to have the dinner yesterday?
See?
Yeah, that is what I was talking about. So it comes to a very important point. That means the key of any kind of relationship is not the communication, it's the understanding.
Right.
Thank you very much.
Another short break, stretch, sip, and relax, or even post a photo. Let the world know that you're here in Luanda building the Africa's insurance future. Thank you. We're back at 3:20 p.m.
climatic risk adaptation, and access to insurance through Africa Climatic Risk Insurance Facility for Adaptation.
Please welcome Dr. Hassan Bashir, Senior Consultant on Climate Insurance with the African Development Bank. A round of applause, please.
Good afternoon. Everyone had coffee or tea after the heavy lunch, so I am certain no one is dozing. So it's a privilege and a pleasure to speak to you on this very important event and with so many regulators and supervisors in the room. My name is Hassan Bashir. I work with the Africa Development Bank in the Agri and Human Development Department. The bank is fairly big, so there are a lot that happens elsewhere. I am here with my colleague Sotini Nyirenda, and who heads the Adrifi facility, which finances ARC in the Southern Africa region. So he's the boss for Southern Africa. Sotini is here. Sotini, you can wave. Okay, great. So I'm going to take, and I don't know how, I know I have an hour. How much time do I have to make my presentation so that I can plan well?
35 minutes.
25 minutes.
35
minutes. Okay.
Including the questions.
Including questions. Okay. Great. So I have to race. So what I will try to do is take you through the kind of vision for disaster risk financing and insurance at the African Development Bank under the department in which we serve. There are other aspects of the bank that work on that space or raise funds, but I'm just going to focus on a small part of that. Okay, yep. So insurance is recognized as a bona fide instrument for climate adaptation and mitigation. The world over, the main statutes, if you look at the UN FCCC, the Kyoto Protocol, the Paris Agreement, all of those underline insurance as a de facto bona fide instrument that's well understood and known and provides support for resilience building and climate adaptation. It contributes to financial resilience, creates de-risking possibilities, and enhances preparedness. So this is very important backdrop. The fact that this instrument is so understood, and the key institutions around the world understand it and accept it as a bona fide instrument for climate adaptation. That said, it hasn't been used so well. Much of the money that goes into climate risk doesn't actually go through insurance. And we have to ask ourselves why that is the case. Climate risk is obvious, well understood, known. The disasters that result from it. We know that there's financing gap, and we know that there's insurance protection gap. Why insurance hasn't been used so well so far, the insurance industry hasn't been deployed in that sector, is a question we need to answer. In terms of gaps and what exists, the current state, you can see Africa's adaptation needs to 2030, 580 billion, gap of 453 billion during that period, and action so far of 29 billion. That is the real situation at the moment. That one is too far. So sorry, I have to look back. Yeah, so however, there are quite a lot of instruments that exist that are available to the insurance fraternity. There are quite a lot of instruments. What happened? Okay, there's a lot of funding available. This is pulled out from the 10-year strategy of the bank. So CDRFI, or disaster risk financing and insurance, is a key pillar within the bank's strategy now that focuses on mobilizing funds and working with industry and governments and regulators and towards deploying that instrument. So this is where I spend most of my presentation. Here is just one slide. This is the program Sotini, my colleague, manages in Southern Africa. It's been here for a decade. ADRIFI is Africa Disaster Risk Insurance Financing Program or something like that. And the green countries you see are the countries that have benefited from this instrument over the last 10 years. And they're listed there. You can see $89 million at the bottom. This is the instrument that finances the Africa Risk Capacity, the AU entity that deals with climate risk. And so the downside of this instrument is that it focuses on only one company and doesn't really touch the insurance industry, and is deployed. Its funds are deployed through that company. Blue countries are countries that signed, but have not yet gone on cover. I'm showing you this so that you can just see what ADRIFI has done over the past decade and through the Africa Risk Capacity. Okay, this is not really the one I'm presenting. I'm presenting a new instrument or framework that is focused on the private insurance industry in the continent. And so I just wanted to kind of give this as a backdrop. The Africa Climate Risk Insurance Facility for Adaptation is the instrument I want to talk to you about. It comes from that realization that climate risk is probably the most significant risk faced in Africa, and especially the agri-food system in the continent. And it is this that I will spend some time on. As I showed earlier, ADRIFI, that instrument which works through ARC, the Africa Risk Capacity, is focused on one company and sovereign clients only. So it ensures governments, it ensures nations, not anyone else. So the policyholder is a government, the beneficiary is a government, and then the government decides where to take that money when disaster happens. It covered drought, it covered floods, it covered cyclones in Southern Africa and so on, and some of the countries in the region benefited from that. ACRIFA, the second instrument I am focusing on, focuses on what ADRIFI doesn't really do. The private sector, the agri-food systems, the SMEs, the household farmers, and that area, the meso and the micro, without necessarily excluding governments. But the main focus really is meso level and micro level. And that's ACRIFA. So every time I say ACRIFA, I mean Africa Climate Risk Insurance Facility for Adaptation. It's a long name. Allow me to refer to it as ACRIFA. It's Africa with the F and C interchanged, so it's not very hard to remember. This facility's resource mobilization is really focused on those three areas: adaptation, mitigation, and loss and damage are all covered. I have 35 minutes for everything, so I am going to zap through some of the slides, which will be available to the organizers. Over the last 2 years, we spent a lot of time working with the industry, with regulators, with different gatherings of the regulators in East Africa, at AIO in Windhoek last year, and with different actors within the industry, consortia of insurance companies in different parts of the world, East, West, South, mostly. And some of the challenges we discovered that informed the design of ACRIFA were related to what is on this slide. And you have seen that from Ilyas Omondi's presentation earlier. Disaggregated and informality of the agri sector. This instrument, let me restate again, is focused on the intersection of climate change or climate risk, agri-food systems, and the insurance. So every time I mention ACRIFA, I am talking about those three, okay? So resourcing the intersection of those three, climate risk, agri-food systems, because we are the Agri and Human Development Department of the bank, so we focus there, and insurance as an instrument for building adaptation. And this is the only instrument I know that focuses entirely on the insurance industry in the continent. Mobilizes funds and is meant to be deployed through the insurance industry. So if we work with a bank, Bank of Angola, for example, it is because the bank is financing insurance-related and agri-climate risk-related aspects. Yeah, we may finance a bank, but not because we're of simply wanting to finance, but it must have something to do with insurance and agri-food systems and climate risk. So those are some of the risks we saw. Those are the constraints we also identified, and very important for regulators here. We have had so much said about data and data thinness and lack of depth and the inability to design products that are affordable and reachable and accessible because of data problems. So limitations of data, lack of policy and regulatory environment, this being a new area weak research or no research at all in this space. So these are what informed what I'm going to present, and this came from the industry. Many workshops over the last 1.5 years, and data collection and so on. ACRIFA intends to do those 5 things. Okay, 5 pillars. We call these the pillars of the key pillars of ACRIFA. Each one has quite some content. I'm going to go to the next slide and break that down a little bit. Sorry, I saw someone taking a photo. I guess all the presentations will be available to the members. I believe to the participants. Yeah. So pillar 1. And I'm trying to simplify to reduce the notes. Leverage, support, and develop the African insurance ecosystem. Focus, channel, climate funds from wherever. One of the reasons why we are taking this responsibility is we, as part of our research over the last 2 years, we found out that one of the most difficult things for industry to do is raise a bankable proposal that convinces GCF to give $100 million. It's very difficult. The industry does not have the manpower or the sanity to be able to work on a proposal for 6 months, 7 months, 8 months, pump money into that, put very competent people in a room so that they can convince GCF or so that they can convince some other green fund. This is very difficult. Africa contributes, as they say, less than 3% of the damage to the environment, and we call less than 2.7% of the climate funds available globally. This disparity is because we are unable to generate proposals that convince these funds to fund us. So we as the African Development Bank, we're taking this line because the bank thinks it's one of the few institutions that can put people together, competent people together, to be able to create those kind of proposals. So pillar 1, leverage, support and develop Africa's insurance ecosystems with respect to climate risk, agri-food systems, and insurance, those 3 aspects. Okay? Pillar 2 focuses on addressing the acquisition problem. None is more difficult for the insurance industry than pillar 2. The prohibitive cost of insuring a farmer. It's so easy to scope and insure this building, this hotel, and you go back to your office and have your coffee. You try to cover 2,000 farmers, you will burn the capital of your underwriter, of your company. This is real. Okay? And we know that insurance managers are measured and evaluated and keep their jobs on the basis of the result every quarter. We know that. Generally, there has been some accusations on insurers. Why are insurance not providing what they are supposed to provide? And the other accusation has been, why are farmers not taking it? Both of those accusations are wrong. Insurers will take the business if it is doable, if it is cost effective, if there is critical mass, if there is money to be made, they will do it. If there is no money to be made, if it burns down your capital, okay? If you will be fired because of chasing a few clients across the expansive countryside, you will not do it. Let's face it, that's real, okay? And the farmers are not queued outside our office waiting for you to say we have a product. They are living life, which is hard, out there in the field, trying to survive, you know, feed their families, till their land, wait for rain, harvest what they have. They're not in front of us trying to get insurance. So those are 2 accusations that normally come that are wrongly placed. So we have to find what makes the underwriter spend their capital to insure farmers and make it interesting for the farmer to want to buy that product. We have to find that sweet spot between the 2. If we don't, we'll keep singing. And that's a reality. Pillar 3 focuses on product design, range and reach. How do we design products that talk to the client? I was involved in the design about a decade ago when I was a CEO, group CEO in the insurance industry in East Africa. in the design of the index-based livestock insurance, which has now become a standard around the world. And I remember trying to sell to goat owners in northern Kenya a product that insured the value of a goat for a year for 750 shillings. What was that in dollars? It was equivalent to $75. $75 equivalent. Okay. After 3 seasons of trying to sell, and we couldn't sell any much, we sent researchers back to the farmers, to herders, and asked, why are you not buying? And one of the things that came out is that $75 is a third of the goat value. Our goats will be finished if we buy your insurance. That was the reality. And then we went back to the drawing board and redesigned and introduced the index, the tropical livestock unit, which is fodder scarcity, the scarcity of grass on the land, which is now what is insured in the index-based livestock insurance product. And so it's so easy to sit in an air-conditioned office, design a product, have you actually run the numbers, reach a pricing point, and say to the marketing department, go and push it. The right thing to do, and that's what Iais was talking about, is come to from the farmer's point. Ask the farmer, what is your pain? Okay, what will you like solved? And then try to see if that is priceable and insurable. We always come from the opposite side. So Pillar 3 focuses on product design. Pillar 4 focuses on the significant challenge of the African insurance industry, which is a capacity problem. Capacity in data, capacity in human technical people. We take for granted that we have brokers and agents who understand motor insurance. We took for granted that we have brokers who run around and sell fire policy and home policy and the liabilities and so on, and indemnity policies and so on. We take that for granted. These are armies that have been built over the last 50 years. They exist. They do not exist for climate or agri-insurance risk. This is new. This cadre has to be developed. They have to exist for the underwriter to be able to find, to reach the customer. Okay? And policy is one of that. And I will talk a little bit about Agrifa Academy, which is a platform that's meant to, which is a pull out of this system, which is being TOR right now. And the final pillar is resource mobilization. Spend significant energy at the bank to raise enough resources from the green funds around the world and climate funds and push that through the African insurance industry. Not really to come from Swiss Re level and come here, but really to come from the bottom, from the underwriter in the local market and upwards into the reinsurers and the retro markets. So that's the most important slide I will have presented in this. And I can go back if there are some questions. Here is the model we're looking at. And the green is the focus of Agrifa. The most difficult area in the agri-climate insurance space for the African insurer is the space between the primary insurer and the producer. That's the most difficult space. That's where acquisition is. That's where transaction cost is. That's where awareness is. That's where last mile systems are missing. That's where we don't have agents and we don't have brokers. And we don't have foot soldiers who are comping the market like we do for the other products. That's the most difficult place. That's what we want to solve. Agrifa is focused on the space between the producer and the primary insurer. If we solve that, we will be on the way to securing that 17 billion USD premium, annual premium that Iais talked about. Okay? An estimate we did about a year ago with the help of Aon showed us that only eight crops in Africa can account for roughly anywhere between 5 and 10 billion USD in premiums. It's a growth sector. It's the biggest sector in the economies in the African continent. It's the most significant employer. The food on the table comes from agri, especially SMEs and micro farmers. So it's very important. And the blue around it are the support systems, including regulators, the public agencies, technical partners, and so on. So this is more or less the framework that we are working on, that we should channel ACRIFA funds through Africa Development Bank, through this channel, to be able to scale and improve uptake and increase the number of farmers in the continent that are insured and therefore adapted to climate change and its vagaries. Okay, how do we do that? We're looking at some of the things. Again, I was very happy to hear Elias Omondi talk about it earlier. We need a mind shift. We need to move from the traditional thought of insuring farmers, or rather insuring insureds one at a time. One car owner, the second car owner, the third car owner, one house owner, the second house owner, and so on. We need to look at the agri-food systems as the difficult sector it is, but the high potential sector it is, and find out the entry points that make business sense. We know that insurance is a trade of large numbers, that small numbers do not make sense, that shareholders are not willing to finance small premiums that have a lot of pain, that the effort must produce and reward the private capital. And we will not succeed until the private capital of our insurance industry is invested into this sector. We will not succeed. But for that to happen, they have to see it as business. So the focus of at Africa Development Bank, and we are hoping that we will be able to work with the industry to do this, because we are not an insurance company. We do not have the expertise you have. We do not have the numbers you have. We're only hoping to recruit the industry and the agencies and the regulators to be able to work together to reach this. We need to find workable entry points. The agro hubs, the aggregators, the distributors, the cooperatives, the associations, the banks, the financiers, the MFIs, the insurtechs and the other aggregators that exist in the market. And we need to reach numbers that make sense through that, and therefore achieve scale. Okay, here is a very quick example. This is an example in Cote d'Ivoire, 5,000 rice farmers that a number of a consortia of insurers have come together. They are technical partners, again, the blue ones. There are a number of primary insurers leading it. Of course, they are the African reinsurers and so on. So this is an example that has insured the first 5,000 farmers, cooperative-based rice farmers in Cote d'Ivoire. It's just an example. One of the things that, and this informed the question I asked, who did I ask the question? The question I asked Yvonne regarding aggregation. One of the traditional things we do as a insurance fraternity is while we run generally diversified business at the reinsurance level, we do localize the business at the primary insurer level. That localized underwriting at the district level, at the division level, in some country in Africa, it doesn't matter where. It's difficult to work for agri-climate risk. The reason for that is because droughts do not understand the districts. Flood do not understand districts. Pests are the same. Pandemics, other pandemics that are climate related are the same. If it rains dogs and cats here, it will affect the next district. It might affect the next country. Droughts are regional. We have seen over the last decade, droughts are regional. Cyclones sweep through multiple countries. This requires a different kind of thinking from the way we insured cars and and individuals and houses and so on. It requires a thinking to really, and this specific thought is really directed more to regulators as much as to insurers. We need to change mindset. We need to think about how the agri portfolio, the climate risk portfolio can be diversified. It cannot be diversified within Angola only. Okay? We must find how coffee in Kenya and banana in Uganda can de-risk cocoa in Ghana. How can we do that? Traditionally, the model of insurance is a model of sharing. Your car could be, the claim of your car could be paid in 10 different countries and across the world in another continent. Okay, so we understand the business of sharing, facultating, co-insuring. We understand that business. But the regulatory systems we have right now demand that insurance can only be exported through across the border through a reinsurer. That's a line written in most acts. Okay, what that means is that every insurer deals directly with their reinsurer without talking to each other. And there's a thought around, is it possible to change that model and look at the possibility that we bring consortia of Angolan insurers and allow them to deal with a consortia of Namibian insurers? Is there anything wrong with that? Okay? Our regulators believe and accept the underwriting of foreign reinsurers. The reason for that is because they trust the regulators who supervise those reinsurers that we don't even know where their head office is, isn't it? Can our regulators exchange notes and Eric is laughing. Can our regulators exchange notes? Put the minimum standards required for insurance, Angolan insurance system to trust the Namibian insurance system, so that crops insured here can be facultated, can be co-insured there. Okay, so that we can exchange those also. It's possible that the drought that affects Namibia might not affect Angola or Kenya or Ethiopia and so on. Can we diversify? So this is one of the ideas we are toying with. We have talked to a lot of regulators. We have seen interest in that. Of course, we are far away from harmonized regulatory regime. We know that we have 54 countries. It's a huge place, the continent. But this is a problem we need to think for differently at the regulatory level, at the industry level. Can I know how much time I have left?
4 minutes.
Sorry?
4 minutes.
4 minutes.
Yeah.
To the 35.
Yes.
Good God. Okay. So I am going to zap through and go to the Agrifa Academy. This is important, and I wanted to say this for the benefit of the industry and the regulators. Agrifa Academy is pillar 4 of this model that we are proposing, and this pillar is focused on human, data, regulatory, technology capacity development. The things that are needed by the agri-food system and climate risk insurance to be able, for the industry to be able to respond to this. At the moment, most of our markets are front-end markets. We are front-end markets. We legalize the transit of African dollars and premiums through our industry to foreign reinsurers. We do not have the capacity to underwrite, the actuarial depth, the data, and the capital. As a result, we have, somebody was talking about it earlier, we have a desk in underwriters, in primary underwriters. We have a desk, mostly the reinsurance officer, receiving files and transiting through to the reinsurer. That's not a basis for developing a sector that's worth 17 billion That's not a basis for protecting the sector that feeds the continent. The future growth of this continent is agri. That's not a basis. So we have to find a way for the underwriter to have the capacity and take back underwriting. Take back underwriting. Underwriting is now with insurtechs who tell us what to do. That's not a basis. That foundation is leaky. Okay? So we need to be able to develop capacity, and that capacity I'm referring to is human, the technical capacity within the underwriting community, data, the enabling environment, the regulatory development, the things that are needed to ease and support the industry, and finally the technology that's required, which probably is the most developed one at the moment. There are more companies developing technology, especially insurtechs and so on. I am sure I have run out of time. I have few more slides. I'm sure this will come to you, and if there are questions, I'll answer. Thank you.
We have room for 2 questions. Does anyone?
Thank you, Dr. Bashir. My question is on the academy and the capacity building. Is there a way that the local insurance associations or the regulators can get in touch with the African Development Bank with regards to that capacity building for the in-country? And the second question to that is, what is the African Development Bank's proposed method? Is it do you want to go country to country, or do you want to have choose a location and everybody meets there for the capacity building, or is it an online capacity building initiative? How does it work? But also, how can the associations, the insurance associations, but also the regulators from various countries get in touch and be part of the capacity building?
Eric, I didn't get the first one.
How can in-country insurance associations and regulators work with the African Development Bank on that capacity building or participate in the academy?
Okay.
Yeah.
So the ACRIFA Academy is not a school, it's a platform. Our design is that we want to channel support and resources, and ACRIFA itself is a framework. And there are two types of funds that will come into the ACRIFA system. One is the funds we raise ourselves. We have right now $250 million application with GCF, which is in its early development. We also have some boxes within the bank that are ACRIFA aligned that are already funding projects in Ethiopia, in a number of countries. So one fund is the one we raise. The second fund is funds that seek and want to work with the framework we have created, which doesn't matter who raise it. There are a lot of institutions that are looking for that. And so ACRIFA Academy is a platform. Our intention is to catalyze and piggyback on the African insurance systems that already exist and the institutional frameworks that already exist, which include the companies, their associations, the regulatory supervisors, the schools and academies, all the infrastructure that exists. This is such a big place that no one can pretend to be able to create infrastructure that makes scale unless you build on what is there. So the intention is really to work with the institutions that are already there at the regional level, at the country level, and so on. For example, the College of Insurances, the academies, the industry academies, whether it is owned by a company or owned by government or private, and so on. So that's the intention. I hope I have answered.
We have a room for the last question.
Okay, thank you, Enda da Silva. I would like to understand how, Enda da Silva, Angola Actuarial Society. I would like to understand how the co-insurance model that you propose would work. As I understood, it's a co-insurance model among the insurance companies in Africa. What is the difference? Because you can share the risks with reinsurance companies in Africa, as of today, or even with insurance companies in Africa. For example, in Angola, insurance companies can accept risks shared by another insurance companies. So what's the difference with this model that you are proposing? Thank you.
So the correct answer is we don't have a solution. We don't have a solution that I will tell you this is the solution. Deploy, it will work for you. What we understand is that climate agri-risk portfolio cannot be significantly diversified within a single geography. We understand that because it knows no boundary and the risk can be across multiple countries. So let's say you insure maize farmers in one region of Angola. That region suffers a drought or cyclone. You have a catastrophic loss. Okay? Imagine the next year the same happens. So that means then you will at some point reach the conclusion that this risk is not insurable. It's possible that you reach that. What we know is that the industry, given that we have an industry across the continent and companies across the border, we also know that risks that happen, climate risks that happen here do not necessarily happen there or to the same intense. Okay? There are also varieties of agri-produce that respond in different way to climatic risks. We're just playing with the idea. Is it possible for the industry to talk to each other across borders and de-risk each other through diversification, through geographic diversification? Okay? We don't have a solution necessarily. But here, this example, assume we have consortia A in Angola, consortia B is in Kenya, consortia C is Cote d'Ivoire, consortia D is somewhere else. Assume these consortia are working with each other. And before they cede business to the reinsurer, they are co-insuring. Assume you transfer 10% of that risk to each other before you cede it to the reinsurer. So if you are consortia A, you're holding 10% risk from Kenya, Cote d'Ivoire, and somewhere else. That portfolio is more diversified and less susceptible to ban than if you are covering only Angola. There's a reason why reinsurers are more do better business on climate risk than primary insurers. Why is that? Because they hold a continental portfolio. That's the reason. Continental portfolio is naturally diversified, geographically and by product. Could we do that at the primary level on a smaller scale without negating the role of the reinsurer? The reinsurer will always be there. That's our argument.
Thank you, Dr. Hassan.
Thank you.
I know it's kind of hot in here, but it's the result of me being here. Jokes aside, the technicians are trying to fix the issue. And now, a high-level panel discussion to round out the day, Bridging the Protection Gap, a critical issue for inclusive insurance growth across Africa.
That's why I have the pleasure to invite our moderator, my friend, Miss Ulrich Garzebri from Anfisa. The panel will bring perspective from supervisors, development actors, and industry experts. Let's welcome our distinguished panelists.
The other panelists will be Elias Omondi, Peter with E, José Araújo, Miss Mukaminjero, e Macgompi Rafaza. Thank you.
You just put Elias on the screen. Please, we're getting one more chair, I think, or two more chairs, I think. Can we use this chair so long, though? Elias is online. He's online. Yeah, I'll come to you just now. Okay. Boa tarde, todos. My name is Eric Garisep. I'm the General Manager for Insurance and Medical Aid Funds at NAMFISA in Namibia. I also serve on the Financial Inclusion Forum at the IAS. And as a member of this forum, it is my pleasure to welcome you to this important panel discussion on bridging the protection gap and expanding access to insurance. So while African insurance sector has made meaningful progress in recent years, the reality is that millions of people, especially those in low-income, informal, and rural communities, remain without adequate protection. We saw the insurance penetration rates earlier this morning, and yet we also at the same time are remaining optimistic that we are embracing this room for improvement. Today's conversation brings together a diverse panel of experts from regulation, reinsurance, actuarial leadership, and development finance. Together, we will explore the practical strategies needed to expand access to insurance in a way that is inclusive, sustainable, and resilient. As you notice, resilience is the topical theme of this seminar. We'll also be looking at the roles of proportionate regulation, public-private partnerships, innovative product design, technical capacity building, all of which are critical to building trust and unlocking meaningful coverage for the underserved populations. I look forward to an engaging discussion, and not only highlights the challenges, but also shares concrete solutions and inspiring examples from across the continent. We will also open the floor to you, the audience, for questions towards the end of the session. I promise you I will not keep you here long, but I don't want to keep you long, but it is quite a very important discussion or topic in the African insurance industries across the board, and I'm really looking forward to hearing from the expert panel that we have on stage today. On stage, we have Mr. Withy, who is the chair of the International Actuarial Association's Professional Committee. He's also Professionalism Committee. He's also an EXCO member of the International Association of Actuaries. We got Mr. Rafaza, who is the head of insurance at the Financial Services Department, head of insurance at the Financial Services Conduct Authority in South Africa. We've got Mr. Njeru, who is the council member of the Institute and Faculty of Actuaries in the United Kingdom. And we've got Mr. Araujo, who is the executive director of the Angolan Society of Insurance, Association of Insurance Companies, my apologies. Mr. Araujo, the first question goes to you. In your opinion, sir, what would you say are the main structural challenges facing Angola's insurance industry in expanding coverage, and what strategies are the insurers in Angola using to reach low-income and rural populations? I will probably have to give you the mic.
Hello, afternoon. So, just a few data about Angola and our reality, okay, just before answering to your question. We have an initiative with ZENIF, it's the National Strategy for Financial Education, that is now ending the public consultation and will be developed between 2025 and 2027. And in this document, the document that is the basis of this strategy that we are going to develop, we have several data about Angola that is interesting for us to understand. So before speaking about how to reach the people with less money and how to sell insurance. We have in Angola 35 million people. 60% live in urban areas and 28% from in capital in Luanda. Only 42% have an ID cards. The informal businesses, if you want, it's equivalent to 40% of our national products. The electric energy is just available for 48.5% of the population. Then, in terms of mobile phones, 72% of the population has access to a mobile phone, and only 32% in rural areas. Okay, so and the bancarization rate is 32%. So just to conclude this introduction, is that, and then this is the conclusion also of this paper, is that 51% of the population is not financially included. So for the moment are outside of our possible scope. What are the companies doing in practice? We have already several microinsurances in Angola, basically life insurance and health insurances, and also funeral insurance. Some companies use it as classified as a life, as a personal accidents, but it should be life. And they are approaching the markets. They are doing lots of tests through agents, through banks, through contact centers, microcredit organizations, other entities like ONGs. One of these days, it was also Cesar from Arsegui was speaking about churches. So we are on the. What we still didn't see here in Angola, it's an initiative through mobile phones. I would like to see someone trying to sell microinsurance through mobile phones. So it's something that, as far as I know, it's still not tested here. But we are trying to, through very different channels and with very simple products to try to explore these markets. So we are in this process.
Thank you for that, sir. So I also wanted to, forgot to introduce the other panelist, Mr. Elias Omondi. That's what happens when you are not coming to visit us in Angola. No, well, welcome. It is the Elias Omondi is the principal at the FSD Africa. You saw him earlier on the screen. And while I'm introducing you, I probably will pass you the second question. We heard about the challenges in Angola and the solutions that the industry is working on in Angola. But your role at FSD Africa takes you obviously all over the continent. In your opinion, what would you say is the institutional or structural gaps that are hindering the development of the local insurance markets in Africa?
Right. Thank you very much. And again, it's great to speak to this particular forum. So in terms of the challenges and what we've seen, we've kind of broken down those particular challenges in three critical buckets that really needs to be solved. Now, the first challenge is what we call the structural challenges. And the structural challenges really kind of connect the demand and supply. And when we talk about that in the demand side, then there's low quality products in terms of what products are available to the customers. Do they really meet the needs? Then on the other side, then affordability becomes a very major issue. So in terms of the structure of the solutions that are being provided, but also what customers are looking for, that has not been solved. Then the second element is on the market. The market is in terms of, if you look at
Sorry, Elias. Is it just possible for the benefit of the translators that you could speak a little slowly, because I think they are struggling to keep up with you?
In my pace, right? I'll try and do it a little bit slowly. Now, the second component is on the market structures, and what we've seen is that the African insurance market is hugely fragmented. And what do I really mean by this? The insurance players and the intermediary and even the reinsurance, there's not that connection in terms of how this particular market operates. So for instance, you'll get that the distribution is still a challenge. The cost of distribution, the cost of reinsurance is still quite high. The products that are being developed do not really meet the needs of the customer. So a lot of market challenges within the ecosystem. Then the last element that I would really want to speak about is what we call the regulatory challenges. Insurance market, again, is hugely regulated. And there's a reason around that, because consumer protection is important. But we've seen an evolution whereby now regulators are also looking into market development. So these three critical components have to be addressed, and that can only be addressed by, for instance, when we talk about the structural challenges, we really need to get products that are quite innovative, that are quite inclusive, and we've seen a lot of solutions that are coming up. In terms of the market challenges, there's need for companies and the industry to work together. The distributors, the intermediaries, and the insurance companies, there's need for that cohesion. But also when it comes to the regulators, then there's need to enable a space to test. So regulatory sandboxes will be quite key in terms of taking these particular markets into the future. So a lot of work is currently happening, and I did share a document earlier that if you scan that particular document and go through that tool, that provides a bullet. I wouldn't say really a silver bullet, but kind of provides insights of what the industry should be able to do to really address this challenge around inclusion. Thank you.
Thank you. So just to summarize those 3 points, it's product mismatch, the needs. There's, what was the second one?
The market is highly fragmented.
Fragmented market and regulatory environment.
Yep.
Speaking on regulatory environment, maybe just a follow-up while I have you on that point. In your opinion, what would an enabling regulatory environment for inclusive insurance look like?
Yeah, so an enabling regulatory environment would really bring three facets. The first facet is who is able to distribute. If you look at the insurance markets across the continent, the distribution is highly regulated in terms of who is able to sell insurance solutions. And earlier I did mention that there is need for us to rethink about the distribution and the regulations around distribution. How can we enable alternative channels to get into the market, but also still have proper oversight in terms of ensuring that the consumers are not exposed? The second thing is around what products are going to come in. We already know that the type of customers that we are talking about require a lot of agility, requires affordability, requires innovative solutions. Then that basically means that there is need for us to rethink about the product approval processes. What does that really entail? It entails that we should be able to allow solutions that in one or the other might not really meet what most of the time we call the insurance rule book. So these particular products might require premiums to be paid irregularly. How does that really play from an insurance, from a regulatory point of view? Some of the products might not require what we call the normal premiums. They'll be paid through other components. I did mention, like in some circumstances, people are using plastic bottles to pay for their premiums. How will that then really mean if a company comes to you and say, okay, fine, we are going to insure women, but out of 40 plastic bottles, then these particular people will get a monthly health insurance cover. So how does that really play from the insurance rule book? And lastly, is around the business models. So some of the business models will be hugely disrupted. What do we really mean by that? In terms of how the product will be taken to market, in terms of the way the customers will be onboarded, and in terms of how the claim will be paid. So all of that will mean that regulations have to support those particular three facets.
Thank you. So basically, it's, if I can summarize that, it is, in your opinion, you believe it is regulation around distribution, regulation around product approval, and alternative business models. Thank you for that, sir. Mr. Rafasa, we're coming back to Luanda now, from Nairobi. In South Africa, you have obviously made some strides and some progress in this area. But can you speak to us about how the FSCA engages with the informal sector or low-income markets segment in South Africa, and how has the FSCA applied the principle of proportionality in its supervision of inclusive insurance markets?
Yeah, thanks very much, Eric, for the question, and good afternoon, everyone. It's very good to be here. I hope I'm audible. I come from South Africa, from the Financial Sector Conduct Authority. As I said, on Tuesday in South Africa, we have got the Twin Peaks model of regulation. So what I'm going to touch on is a bit what we are doing on the prudential side, but I will focus on the conduct side, being a conduct supervisor. So the journey of really having inclusive insurance in South Africa, I would say formally started in 2008 when our National Treasury issued a paper on the future of microinsurance. And since then we have enacted the Insurance Act. And under that Insurance Act, together with the other sector laws that we have in South Africa, then we have the micro and funeral standards, both on the prudential side and on the conduct side. So just picking up on your discussion with Elias earlier about the regulatory environment, I think that's very important because firstly, in my view, I think is really having the right people entering the market. I think the more providers you have, the better. So from that perspective and from a prudential element, what we have done is that we have relaxed the minimum capital requirements. I mean, in South Africa currently, if you were to be a life insurer or a non-life insurer, traditional life or non-life, you need at least a minimum capital of 15 million. But we realized that that was not going to work for micro insurers. So the requirements have been relaxed. So it's a minimum capital of 4 million. So that is really what we have done, and especially from a licensing perspective. But I think the key thing for me is really, you spoke about product approvals. In South Africa, we don't approve products, but we do have got a process where we actually receive notifications, particularly for this low-end segment of the market, when they have to advertise or launch products. There is a requirement in our conduct standards that we have to be notified within 31 days prior to advertising that product. And that's very key, because it helps us to really interrogate the insurer on the product and ensure that before they actually launch the product, then that product will actually serve the interest of customers. So there's a few things, Eric, that we look at there. So we look at benefits, what benefits are going to be offered. We look at exclusions for examples. There are certain exclusions that are prescribed. For example, there's an exclusion for suicide, which may not exceed 1 year. And then there's terms and conditions. And I think the one thing that I want to highlight around terms and conditions, I think it relates to this concept of waiting period, which is very important and can be a barrier actually to inclusive insurance. So what we have seen in South Africa is that sometimes you find that people are perpetually on waiting periods. So what we have done is that if you are approached as an insurer by a prospective customer who wants to buy a micro insurance or funeral product, then there is an obligation on the insurer to actually ask that prospective customer whether they had cover with another insurer in respect of the same policy. We have got a waiting period for 6 months maximum. So if they had served part of that waiting period with the previous insurer, then you can impose a waiting period of 6 months. So that really helps a lot, because if they've been there, they've served 3 months, then you can only put them on waiting period for 3 months. So that's very important. So I think the other thing that is very important, and I think it goes to advertising and material. So we also look at the advertising material before actually the product is being launched. And there is a requirement here that that advertising material sorry, I don't know where I lost the audience, but there's a requirement in terms of am I audible? Eh?
Yes, probably speak like more into the mic.
Yes. Okay. Yes. So the other interesting aspect is the advertising material. So we also look at the advertising material, and there is a requirement in the legislation that must be approved by the senior manager of the insurance company, which in our legislation then is the CEO. So that's very important, because then at the top structure of the insurer, then they also have to look at their marketing material. And lastly, maybe just 2 points before I revert to you, Eric, is really when we are not satisfied about these aspects that I have mentioned, we can actually object to that notification, and we can actually instruct an insurer to do one of the 4 things, either to stop marketing the product, or not to renew, or we can also instruct them to terminate the policies, but following the requirements in the legislation, which I can talk to if there is time. And then we can also ask them to amend the terms and conditions. And then the other thing that is very important, I think, is what Elias touched on, is around distribution. I think for me, it's very important to ensure that these products are really being distributed in a way that is very accessible. I think everyone now is talking about technology. But sometimes technology may not be the right way of really distributing this kind of products. So I always say when I speak to insurers that I think the important thing is to know your target market. There is no point in, for example, distributing the products by way of a smartphone when a large number of your customer base does not even have access. They don't have a smartphone. They don't even have data, because data is also one of the issues in other parts of Africa. So disclosure, very, very important. I won't dwell much on that. But the one last aspect that I want to touch on, which I believe is increasing the penetration in South Africa, I think, is how we deal with claims. So in respect of all other policies, we say an insurer must settle a claim within a reasonable period. But in respect of microinsurance, we've been very intentional in terms of determining the period. So we have said that an insurer, a microinsurer, must pay that claim within 2 business days of having received all the required documentation. So that is very important. And then the last aspect around claims is that in South Africa, we used to have funeral parlors who were also policyholders under our legislation. What we have seen there is that then the insurer will pay the benefit to the funeral parlor, but that benefit will not reach the end customer. So what we have done now in the legislation is to say that you can never have a clause in a policy saying that that benefit will be paid to a provider. It must be paid to the end customer, unless the end customer actually consents to that benefit being paid to the provider. I think there's a lot to say in terms of what we have done in South Africa, but in the interest of time, let me pause there for now. Thanks, Eric.
Thank you for that. So if I can just, please keep me honest here, summarize this. I would say that you're saying there's an element of relaxed capital requirements, streamlined product approval process, product features suitable for the segment, streamlined ethical marketing requirements, ensure accessibility within the distribution models, and appropriate claims turnaround timelines.
Correct.
Those are obviously there's more, but these are the ones that you can probably, in the interest of time, otherwise we're leaving at 8 o'clock tonight. Okay, I will actually have to move on to our only lady on the panel. I don't know if there's something I should have said, but Ms. Jerun, from your perspective for the Institute and Faculty of Actuaries, you're obviously based in Nairobi, but you serve on the UK body. So what role can actuaries play in driving innovation and inclusion in the African insurance markets?
Thanks, Eric, and good afternoon, everyone. I think it's my first time to be on this stage, so I'm really privileged to be here. Yes, Omokaminjari is my name, as Eric has mentioned. As much as I am a member of the council, I'm also a practicing actuary. And I want to answer this question maybe initially from my own experience. So my first couple of years working was as a consultant, but my first in-house role was in an insurance company called CIC in Nairobi, Kenya. And it's actually a mutual-based insurer that insures mainly savings and credit cooperatives. It's in Kenya, but also it has a few regional branches. So one of my first assignments as their actuary was to help in an exercise called product rationalization. And in a bid to be innovative, what the company had done was design products for any customer needs that someone would want. Yeah, so they would have a product with 2 clients, a product with 10 clients, a product with 500 clients, all taking operational sort of expenses and so on. So that was my first experience of innovation, extreme in a scenario where perhaps you've not gone through the product development process, and really bringing me to what the role of an actuary is in this innovation and inclusion space. So I think the role of an actuary is to use data for good. I really like what the decision making is with this team and with everyone else, and we give our views. So it's not only about pricing, it's also understanding the market and the product. So moving CIC from having 52 products to having perhaps 20 that made sense for the clients and for the market was actually a good gift to give the company as an actuary, right? So that's just to say that's what actuaries can do. Now, my role after that was in a reinsurance company called Swiss Re. So I moved to lovely South Africa, but I was handling the East Africa life and health portfolio. So you have this company with a large, reinsurance balance sheet that they want to deploy, but they have so many rules that curtail like the innovation we need to ensure inclusivity. So if you say that, all products must have 5 years worth of data, right, before you can price it, what do we actually do when we want to design critical illness where we don't have the cancer statistics yet we are seeing it's an up and coming trend, right? So the role of actuaries is also to advocate, for the needs of their market, or even for the needs of the client, right? Because what we know from actuaries is that we see a lot in the data. We probably have a lot more information about the complexity of products than other people around the room. So it's actually a responsibility to ensure that there's, a harmonious understanding of the issue, and to make sure that the people who are managing the risks get comfort from us. So how do we convince us to do a cancer product in a new market where they haven't done it before, but they have the expertise, right? How do we get the market to the level where it needs to get that kind of cover? And we're able to do it with one insurer who had a proven track record, right? Mm-hmm. So just to say that the role of actuaries is also to see themselves as part of the system which they are modeling. So we find sometimes actuaries step back, and we actually had to introduce a principle called speaking up in the actuarial profession, because actuaries would be seeing things going wrong or not going so right and not actually speaking up. So that's one of the key roles I think that actuaries can play. Now, generally, the other things I would want to say is that actuaries have a role to play in simplifying the process. Underwriting and risk-taking can be quite complicated. You don't want clients filling policies with 30 questions when there can be 3. So there's a lot of that. Actuaries have a lot to play in terms of, a role to play in terms of making sure that we don't exclude the most extreme risks. So, of course, as someone who's working for the insurer, you want to protect the balance sheet. So you want to remove everything that is the riskiest. But really, that's where the need lies, right? So actuaries now, especially product actuaries, need to think about these uninsured risks or these uninsurable risks. And that's why I really like what a lot of the presentations I've seen today, like what Dr. Hassan is doing, looking at the things that traditionally were not being insured and thinking about how can we actually insure them. I mean, South Africa has been really good with HIV, for example, which had been excluded for long, but these are actually actual insurance needs. So even as actuaries, we need to move from that point of being risk averse as we advise and price and find the right solutions. So I think those are some of the things that we can do. But for me, I think it's about advising correctly, speaking up when we need to speak up, and ensuring that the right decisions are made around the tables they're on.
Well, thank you. You summarized it for me at the end, though, so I will skip my summary of your question, of your answer. Speaking of products, I would like to maybe jump to Mr. Withy. Can you share with us, maybe from a product and solution perspectives? And I think Akombi mentioned it earlier on as well. What are some of the ethical considerations insurance product developers must be mindful of when designing products or solutions for the vulnerable population?
So thank you, Eric. So I'm answering this question in the context and with the hat on of the chairman of the Professionalism Committee of the IAA.
because I could answer this in very many different ways, but I'll answer it from that perspective. So I think the first thing to note is that any actuary who is a member of a full member association of the International Actuarial Association is subject to a code of conduct. And those code of conducts always have in them certain elements. One element is integrity. And another element is in various different forms, and there's been a lot of debate about this within the industry, within the profession as a whole, is around the responsibility to uphold the public interest. And I think that's one of the challenges that actuaries have in this space, is that you've got to uphold public interest, which is keeping in mind the interest of the end consumer, but at the same time balancing the person that pays your salary. So that is another principle or principal as a person to whom you are responsible. So it's finding the balance between those things. And Mukami mentioned the word speak up, which is very clearly spelled out within the IFOA Code of Conduct, that you have a responsibility to speak up if you're uncomfortable with the ethics or the integrity of a process. So if you as an actuary are doing your job properly, and there are a lot of ifs in that, if you as an actuary are doing your job properly, you should be balancing all of those ideas in your mind, all of those thoughts and different stakeholders in your mind, and seeking to come to a fair balance. I liked what Dr. Bashir said earlier in his presentation of finding the sweet spot between the provider's willingness to cover and the customer's desire and affordability of cover. So the actuary, I believe, plays a role in finding that spot. If you simply view yourself as a technician and all you do is calculate numbers for somebody else, I'm not sure you're performing your professional responsibility. But it is a challenging space, and particularly for young and relatively newly qualified actuaries who are often doing these calculations, it is a challenge to speak. But that is the ethical responsibility that we have. So I come back to the fact that you need to, as an actuary, keep the public interest in when you're doing your job. And I guess that's the professional element of it.
Well, thank you for that, Mr. Wadi. Mr. Araujo, you're sitting in a room with diverse stakeholders, regulators, industry participants, development partners, consultants, and many, many more. From your perspective, what support does the Angolan insurers need in order to scale inclusive insurance sustainably? Mike?
Okay. It's a question, I was saying it was a difficult and tricky question. The question is, normally when they ask us what we need, my tendency is to say that what we need is to, as I told you before, to test things, okay? So we know how to develop products, we know how to price products. What, as I was saying here, we must, in this case, is try to develop products according to the needs of people. So this is but if we can, so this is a process. So, and what I see in several companies here is they are testing, and they are not in first wave of products. They did the product. If it's sold, if it is, people like it, they will keep selling. If they don't like it, they will do a new product. So this is a process, because technically what we know, how to develop products, how to price products, all those things. This is not our big challenge, One thing that normally people, when I speak about these things, is the people speak about fintechs, insurtechs, and all those things. And normally my message is, of course, we would like to test these things, but things that are already tested. What we don't need now is people to come here to try to test, to test in a market that is beginning. So we would like to have some of these the insurtechs or fintechs, whatever, that had already solutions proved in other countries, so that we could try it here. So basically, it's and as I told you before, I would like to have tested here in Angola an insurance sold through mobile phones. But for this type of, it's something that is still not tested, and I would like to see it, but it will happen naturally in one of these days.
So it's the testing models that the fintechs around the continent has already achieved in other parts and testing it in Angola, those solutions here, and see if it will work out, and as well as mobile distribution as well. Am I getting you correct?
Yes, as I told you, we would like to test here things that already proved in other countries.
Yes, yes.
Because sometimes I already had some experience at the association, people that are having an idea, and they want us to help them to implement the idea. But what we need is things that are tested, because I spoke already with several people in other countries, in other companies, and most part of these fintechs and insurtechs, they will not survive more than 1 or 2 years. So we don't. We prefer to don't do tests and try to work with things that already are tested and have had success. And that we can, in some way, analyze the costs and benefits of the solutions.
Thank you for that. Speaking of testing, and I know Elias mentioned it earlier on when he spoke about sandboxes. I would just like to ask, can you share with us what role the FSCA sees for regulatory sandboxes in supporting responsible innovation, and maybe perhaps give 1 or 2 examples of how you have utilized this in South Africa? I mean, any success stories that you can share with us around that?
Yeah. Thanks very much for the question, Eric. So in South Africa, we have got the regulatory sandbox that we use, and then we have got an innovation hub, and various regulators are actually part of that, where we actually look at these products. So the products that we have really tested through the regulatory sandbox up to so far, Eric and the audience, there was a product that was a weather indexed-based insurance product that one of the big non-life insurers in South Africa wanted to offer to customers. So this was really aimed at assisting small farmers to manage their crop risks, particularly drought conditions. It was run as a pilot project, and then it covered 9 small holder farmers in a dry farming area. So what happened here is that there was a satellite data that was used to actually calculate the level of the moisture in the soil, instead of using the traditional assessment methods that we use. What we did here as the FSCA, our role was on a monthly basis then to meet with the insurer, to meet with the Prudential Authority, and we are also on a monthly basis really tracking how the insurer was doing in respect of complaints and claims on the product. The one thing that we did, and I think was very good, was also to ask the insurer to actually do a survey and amongst its customers to really determine what challenges they were experiencing with the product. And what the insurer shared with us was that most farmers were actually happy with this product. But what we did see is that some of the farmers, even though they were happy with the product, they felt that the product was actually limiting because it was really covering drought conditions. So some of them wanted it to cover even instances where you have got excess soil moisture. So there was a suggestion to actually expand the coverage of the product. There was also a suggestion to actually consider lowering the insurance premiums. I think overall what we did find with this pilot project, and there was a financial services provider that was assisting to guide this 9 farmers that I'm talking about. So at the end, it was really a success story. And overall, these similar products now are being considered by the Prudential Authority. As we were talking earlier in the week, I mean, this is related to parametric insurance, which we know that is not insurance according to our law. But we do have got a provision in our legislation that insurers can do other business other than insurance business. So following the success of this project, Eric, then other insurers have been able to offer similar products. So for us, this is really quite good. And then I think it's really contributing to inclusive insurance. And then I think what is exciting here, then you can see the use of technology in a right way to actually increase insurance penetration and coverage. Thanks.
Thank you for that. But I think when you have those kind of innovative solutions, they require technical skills, obviously, and we would agree to that, obviously. So
absolutely,
I think with that is probably the time to jump back to our only lady on the panel and ask her then, how can the African insurance companies, I mean, like our colleagues here from the Angolan insurance industry in the room today, as well as the insurance supervisors that are in the room today and are not in the room today as well, how can they collaborate with the IFOA to strengthen the technical skills needed to drive innovation and support the growth of a sustainable micro-insurance industry?
Thanks, Eric. And I think after this, people may start calling me the only lady in the panel. And anyway, right. So the IFOA is a member-led organization. That's the first thing to say.
Sorry, I think the IFOA, just to say, is the Institute and Faculty of Actuaries in the UK. I jumped straight into the acronym. Yeah, sorry for that.
Yeah, occupational hazard, but it's a member-led organization. I know some organizations are different, like they take the strategy to the market, but how the IFOA works is that we listen to the members and say, okay, there's a need, climate change is coming up, okay, let's establish a thought leadership and working party and so on, and let's let the IFOA members who are passionate about that run with it. So that's to say the solution will lie with us. A lot of the actuaries who are training in Sub-Saharan Africa are actually IFOA members. So that's the first thing to say. So at least we have a captive pool. A lot of your actuaries in your regulatory authorities or even in the insurance companies are either members of the IFOA. I know ASA is here. I know Yvonne is here from CAS, but a lot of them are IFOA members. So the question is, how can we aggregate this group of actuaries across Africa and put their needs in a way that the IFOA can also channel directly to? Currently, what the IFOA does is that it works with the in-country associations. So I'm glad the Angolan Actuarial Association is here. So that would be the first point of call to deploy skill sets and training and so on and so forth. But I think what we are trying to do here, and it's a discussion we've actually had with Iais as well, is to see, can we develop modules that are relevant for the African context, especially on this sort of innovation and microinsurance type, because a lot of the content we have right now on the virtual learning environment is driven by where half our members are, which is the UK. Of course, some of the people working in the UK have contacts in Africa. So a topic like COVID, the thought leadership will assist everybody in the world, but for something like disaster risk financing or modeling catastrophe risk in Africa, that might not come from the IFOA, it might need to come from us. And a good example is the banking qualification that happened in South Africa, where the South African profession actually designed this because it was a market need and now it's being deployed globally. So I think that's how I would want to see the collaboration on this specific area, Eric. And some of the things we are thinking about doing, forming an Africa committee within the IFOA where we work on that. But really it's to work, as I said, with the local organizations, with the regulators. On Monday, TIRA, the Tanzanian insurance regulator, was in Kenya doing a market visit. And one of the things they're thinking of doing, because they don't have actuaries in Tanzania yet, is housing the actuarial profession with insurance and pensions until such a time when it's ready to deploy and develop. So I want to say how we can work on this is actually collaboratively, and that there are a lot of shared problems across the continent, and for us it's to aggregate. So I'll take this commercial break as an opportunity to tell you about something called the African Actuarial Development Academy, which is something that's seeking to do this specific thing of aggregating the needs across Africa so that we can channel resources from whether it's the IFOA, the SOA, or whoever else can develop the actuarial profession. So just to bring our shared problems together, if we get trainings and toolkits, then we can deploy them across the continent where everybody has, access. Similarly to the academy mentioned for ACRIFA, it's going to also be a virtual environment where we can collaborate there. But let me just say, Eric, that it's a journey that we really want to go on as we increase the number of actuaries in Africa. Because, as I said, at the end of the day, it's a game of numbers. The IFOA has 30,000 members. And if most of them are not in Africa, then a lot of the solutions that are designed may not be fit for purpose in Africa. But the strategy is actually to get the IFOA members in Africa to lead these discussions and to design the right solutions. What I also want to say first as well, or last, I beg your pardon, is the fact that I do find that the actuaries training in Africa, where you don't have the comfort of working in a team of 50 actuaries. So when I first went to my first job in Kenya after working in the UK for a bit, there was less than 20 qualified actuaries in Kenya, and I was the only qualified actuary in the company. So by virtue of that, Eric and the panel and the team, it already requires you to be innovative. I think I've heard someone else say, if you're an actuary in Africa, you can't say you're a life actuary, you're a J actuary, you're a health actuary. You actually have to be versatile. So we've already created an environment where actuaries are innovative. And if you look at, some examples of things like Pula or something that, which is an insurtech run by an actuary, although he has a business partner, and, sort of actuaries doing out of the box roles. If I look on average, so outside of South Africa, there are less than 200 qualified actuaries. And if you look at that number in proportion, you will see that a lot higher proportion of that number of actuaries is in innovative type roles if I compare to the colleagues in the UK or more developed environments. So I think there's already a good recipe there by the way the actuaries in Africa are brought up. So I know they're definitely up to the challenge. But as I said, for us is to support them with the right infrastructure and toolkits and really regulation and guidance. So I really like what is happening in South Africa, and I think some of those guidelines are what are necessary to enable them to operate effectively.
Thank you for that. I'm going to give Mr. Withy the last question before I hand over to the audience for questions. Maybe they've got questions they want to ask, or maybe they want in a rush to get out of here. I know time is catching on us. You've obviously been around the continent. You've done your fair share. In your opinion, what are the next steps for countries that are with low insurance penetration to catalyze in sub-Saharan Africa to catalyze growth? What would you say should be the next steps for a country like that?
So this isn't really an actuarial question, and it's difficult for me to answer this question with my hat of the IAA Professionalism Committee, so I'm going to take that one off. I'm going to put on a mixture between the IAA Executive Committee, the Actuarial Society of South Africa and Stakeholders Board, which are other roles that I carry. I think that we've spoken a lot about the things that are needed to make the industry, and particularly inclusive insurance, microinsurance, and those factors develop. And I think we've spoken a lot about that today. So I can't repeat all of those other than to affirm that those are important elements. I think having technical skills and business skills, and I think Mukami just mentioned that many actuaries in Africa, and even within South Africa, where we have the largest organization of actuaries on the continent. We have qualified actuaries of just under 2,000 in South Africa, and membership of 4,500, 5,000. So we're the biggest organization in Africa, but even at this stage of our development, which is quite far, South African actuaries have great wider experience than just pure technical work. And I think that brings, I believe that actuaries can bring advantage to this space. So, and I acknowledge I have a bias towards actuarial skills and supporting the actuarial profession. So I believe that one of the things that can help is to bring on actuaries who have both a technical skill and the ability to think wider and bring more than just be a technical actuary. We don't have the luxury of pure technical actuaries in South Africa. You can go into Germany, USA, UK, and others, and you can find somebody who is extremely well versed in a particular minute piece of actuarial work. But in Africa, you need people who've got wide experience. And I think that developing the actuarial skill set, developing the insurance knowledge skill set is a key element of growing the industry in Africa. And I've spoken already about some of the IAA initiatives to try and help regulators in particular, because of our joint arrangement with the IAIS, to make that work. The second thing I think that for me, and now this is me speaking as a person, is for consumers to understand the value that insurance can bring. And I think that that's one of the challenges that we have as an industry as a whole. I look at some of the poorest in South Africa, and I think of what happens when a disaster strikes their home. They lose everything. Little as it is, they lose everything. I could not afford to insure losing everything. I insure losing a lot of what I have, but I can't insure, and here are people who have no insurance whatsoever. So to understand the value in terms of what insurance brings and how that actually helps to build generational wealth over time, because the family loses. You lose a breadwinner in the family, and you've lost future income. You lose home, you've got to replace that out of your own pocket. So that understanding and education of consumers, to me, is fundamental. And that's me expressing a personal view.
So thank you. I was actually asking for your personal opinion. Colleagues, I would like to shift the focus to the audience, the room, just to find out if there is anybody that wants to direct a question to any of our panelists on stage. There are mics roaming around. And are there any questions you might like to ask our panelists? There's a question in the back there. I almost thought that we just want to get out of here. There's a question in the back there. In the back there. Can we have a mic there, please? Where's the microphones?
I think all the microphones are here.
Yeah, that's true.
Good afternoon. My name is Engelbert. I'm from Namfisa,
That's from Namibia. I have about 3 questions to Mr. Rabasha from FCA. You mentioned this with regards to your claim settlement period. You mentioned that in SA or in South Africa, you take about 2 days to settle claims. Okay, so I wanted just to know in which, what type of products are this one that we are talking about? Is it in the non or life sector? And secondly, do you have guidelines perhaps that guide the settlement processes? Or in other words, how do you ensure entities really settle claims within 2 days? Okay. The other one, if you maybe share what type of system do you use to track that indeed these entities do pay within 2 days? In other words, what mechanism do you have in place that ensures that indeed settlements are paid in 2 days? Yeah, basically that. Thank you.
Thank you, Namfisa, colleague, for the questions. So I see you are really interested in settlement of claims, which I think is very important and it's understandable. So your first question around whether what products am I talking about? So if you're talking about micro insurance, you're talking about both life and non-life. So micro insurers in South Africa are composite insurers, so they do both life and non-life. So any micro insurance claim then has to be settled within those 48 hours that I've spoken about. And there's a similar requirement for funeral policies as well, which is really on the life side. But the short answer to your question is that it's actually both life and non-life, if a micro insurer is doing both. I didn't get your second question, sorry, you will need to repeat that for me. So your last question is around the systems that we use to really actually track that. So we have really spoken about the returns that we are receiving and any complaints that we may be receiving. So we work with even the ombudsman in that regard. So there is really no specific system that we use to really track that. In as much as we want to be a proactive regulator, so in certain instances you have to be a bit reactive, normally because you are dealing with people that really need that money urgently to conduct funerals. They will immediately complain if the insurer is taking more than 2 business days to settle the claim. I think if you can just repeat your second question, I might have answered it in answering the first question, but if I didn't, please repeat it for me.
He was asking, are there any guidelines
for settling claims? Yeah, look, there are really no specific guidelines. I think what we are just saying is that if you have received all the documentation, and each insurer has got a different documentation that they will require before settling a claim. But what I've seen is that there's no material difference between what each insurer will require. Most of them will require a death certificate, will require a certain document from the funeral parlor. And normally when a person has passed away, then your identity document then will be stamped by Home Affairs to indicate as such. So generally, it's those 3 documents. So we don't have guidelines. What we do test is really, and to make sure that the documents that you require to settle a claim don't constitute a barrier to a claim, because one of the requirements, as you know, around TCF is that customers should not experience any post-sale claims barriers when they need to be serviced by the insurer. Thank you.
Thank you for that. Much to the detriment of my timekeeping skills, I will ask if there's one last question before I close the panel. Going once, going twice, gone. With that, I would like to thank my panelists for the insightful. Can you give a round of applause for them? And thank you very much for indulging us for this hour we were on stage. And I will hand back to our directors of ceremony. Thank you very much.
Thank you, Eric. We would like to invite the chairwoman of ARTEC, Filomena Majata, to come forward to offer a gift to our today's speakers. We also invite the speakers to the stage, please. Takalani, Yvonne Palm, José Araújo, Hassan Bashir, Peter with E, Operi Kapama, Vanessa Padayesh, Mac Gompi Rafaza, Floris Flirmus.
No more? Can we please ask you to just line up in front of the sign with the chairwoman so we can take a picture?
Thank you. Thank you, Dr. Filomena Majata. That concludes today's program, a day marked by substance, vision, and a strong regional engagement.
Well, for now, we just want to thank the panelists, participants, keynote, speakers, and in general, everyone who made this such an incredible day. And we look forward to see you tomorrow. And we kindly ask you to rest.
take the rest of the day to rest, because I know that yesterday party was hard. We have to be back tomorrow at 9 a.m., please. Thank you.